Hi students, we begin with our CMSL marathon. I am Professor Zubair Jahangir. I'm a company secretary and advocate, and I've been teaching this entire course, including this subject, for over 12 years now. So what we will be doing, we will be having since years of experience. I can complete this entire part in a few days time. So my target for today will be to complete your entire 40 marks. So this 40 marks will be covered, okay, so you can easily attempt. While doing this, it will be I will be stressing upon topics that are important from exam point of view, and which are not important from exam point of view. A conceptual overview will be. So let's begin with our lesson number 1. Hi, so we begin with your first lesson, that is called as the basics of capital. Now when we talk about the basics of capital market is a part of the financial system of India. It is a part of the financial system of India. Now what is the financial system? Pay attention. So it is a system where financial instruments are exchanged. What are exchanged? Financial instruments. Okay, so if we go to see, you have your financial instrument. Now sir, what are financial instruments? Okay, so financial instruments could be like your shares, etc. Shares, debentures, bonds, etc. Okay? So where financial instruments are traded. So there will be investors. Now investors are the ones who will have surplus funds. What do they have? They have the surplus funds. Now these surplus funds, they give it to entrepreneurs, business owners, companies, etc. Okay, so corporates. Now corporates have businesses to do. They will take your money, they will do business, try to earn profit, increase the value and give it back to you. So the corporates, they want to use it for doing business, for business. So there is a exchange. What is there? There is a exchange of, from this side investors will give surplus funds, and from this side the company will issue financial instruments saying that you have so much rights in this instrument. As the value of this company will grow, automatically the value of your share, the value of your company will go, and the main objective of the investor will be fulfilled. What is the main objective of the investor? Is to convert his surplus. The main objective of any investor is to convert his surplus funds into. Now keep this concept in mind, and you will see that the first part talks about this. That this is a financial system. Investors give their surplus funds to convert these surplus funds into proper investments to companies who need these funds, who have entrepreneurs who will do business and increase your value. So if you go to see, your financial system can then be called that, listen, we have instruments. As I told you, all the financial instruments that we will be studying, you must have studied, these are all what corporates issues: funds, or your shares, debentures, bonds. Okay, and governments can issue government securities. They will also require, they issue those kind of security. The participants, okay, now who all are the participants? Two participants. So we know the issuer. So there are actually three participants. If you go to see, sir, how three? So one is the investors. Okay, I know you know this, investors. Second party obviously we know is your the investors give their money to whom? To the corporates, companies. The third participant is called as your intermediaries, like your brokers, okay, and other intermediaries. We have a dedicated chapter. Now interestingly, when you go to see, your market, okay, your financial market can further be divided into two classes. One is money market. Now pay attention, money market, and the other one is called as capital. Now, capital market is what you normally know as a company secretary. So they are long-term instruments. So when I issue it, I'll be issuing for a longer time, more than a year. When I say long-term means what? Greater than 1 year. Normally, capital markets are controlled by SEBI, the subject that we are studying. Even government issues are issuers. Maybe government needs to build roads, they need to meet up the fiscal deficit, the expenses they the money that they collect from taxes might not be enough to meet the next year's expenses. So what do? Government also issues money market instruments. Here the regulator is RBI, and they are generally issued, or not generally, mandatorily issued for less than 1 year. Okay, less than 1 year. Simple little instrument. And money market, again we can see, is example is your government securities, etc. Treasury bills, which are, okay, they can be issued for 9 days, 81 days, 180 days, like those. Now, as we go into this, we'll see that there are stock exchanges. Okay. Now, obviously, the companies, they access the investors. How do we invest into companies, IPOs? So it is always through stock exchange. Now we have two national stock exchanges, okay, which are on the main board, which is your BSE, which was the Bombay Stock Exchange. Okay, it is the oldest stock exchange. Okay, it was in 1875. It was founded in 1875, whereas you have NSE, which was founded around 1992. Okay. Now, functions of a financial market. I've already told you. What did I tell you? First, they channelize the savings into investments. They exchange of this and provides liquidity or funds to the market. Money market we have done. What it is, money market? Sir, money market is a financial market. It is a segment of financial market, as we did. And here it is short term, okay, and regulated by RBI, okay, mainly regulated by RBI. Some of the money market instruments where companies can also issue for less than 1 year, then SEBI will come into play. But the main regulator of money market is RBI. If a company is issuing short term securities, then SEBI will come into play. Okay, it gives liquidities, funds to the entities. Okay. Now, similarly, capital markets. Sir, what are capital markets? Capital markets again are long term, okay, greater than 1 year, okay, and they are treated as the barometer of the economy. Obviously, if a stock market is doing well, we will state that the economy is healthy. If reverse, if we see the stock markets crashing, that means that the values of companies falling down, that means the economy is not in a good state. So it is treated as a barometer of economy. Okay, so all this just a conceptual thing, not meant to be asked in the examination. Okay. So as we see, more or less it will rotate around the same thing. It will treat as a linkage of converting your savings into investments. Same thing will be. Now we come to the important aspect. Further, just before we get into that, there is something called as a primary market and a secondary market as well. Now pay attention to what is a primary market and secondary market and a distinction between them. Okay. Now, you must have seen in the market there is multiple companies coming out with IPO, coming out with an initial pumping offering. That is when for the first time we go and raise money. Okay, we go and raise money from public. It is called as primary market. Where now I want you to write it down. Okay, what happens in a primary market? In a primary market, fresh securities or new securities, I will say, new securities are issued. Here, company goes to the investors. investors pay the company. Simple, done. So once the company will issue the securities, the company will get funds. So it increases, it introduces new funds to the company. Company gets more funds, fresh securities are issued. They raise funds. So what happens in primary market? New securities are issued to the investors. The investors give the money to the company, so the company's funds will increase. Very simple. Just like think like you are buying a flat from the builder. That is a primary sale, first sale from the from directly from the builder. Now, after a person has bought the flat or after a person has bought the shares, he wants to sell the shares. He will sell it to another investor. So it is a sale of existing securities. So when you sell existing securities, okay, when existing securities are sold, it is called as secondary market. Here an investor who had bought the shares will sell it to another investor when he gets a good price, or when he needs the money, or whenever he wants to sell. Here the money by the buyer will be paid to the investor only. So if you sell your flat now, the money you will get, not the builder. So this is called as secondary market. Now this, when I ask a question, mostly students get it wrong. And now let me ask you, IPO everybody knows will come here. Where will FPO come? FPO. So FPO will also come here. Why? Because company is raising funds again, selling new securities for the second time, third time. Whenever you sell new securities, it's a primary market. Whenever the company gets the funds, it's a primary market. Secondary market is when the investor is selling to another investor. Simple. So it's a trading. Today when I buy Reliance shares and I sell it, it is a trading. That trading will be given, I will get the money and I will sell my shares to another investor. Simple little concept. Now, there are different, laws that are there. All the laws which we have in our syllabus. So right now you don't need to stress on it. SEBI Act, okay, SCRA Act, Depository Act, Companies Act. Sir, what are these acts? These acts are separate chapters in your syllabus. Companies Act, we have a subject, and all these three acts are all the next three chapters if you go to see in your syllabus. So this we will come to know when we do it. Okay. Now, SEBI, again there is a chapter. So SEBI is a regulator of the markets. They ensure that there is a smooth functioning of the market. But just if I just go to give you a background, you don't need to do it from here. There is a separate chapter called a SEBI Act. From there you need to do. So SEBI is the regulator of security markets. Before SEBI, there was a controller of capital issues. Okay, that was there. Controller was there. He was removed. He was replaced by SEBI. Okay. So SEBI Act was there, established in 1988. Before that, who was there? Controller of capital. Okay. Now, participants. Now we come to the part where they come in the exam. Now this, till now what we have done is general knowledge. Till now what we did was general knowledge. It is not meant to be asked in your examination. If they ask, it's a bonus. That is not what comes. From here, I will be telling you what comes in your exam. That was just the basics, super basics of financial market. That financial market, if I just take a breakdown again, okay, you can make it. What is a financial market? A financial market are basically a market where financial instruments are traded. There are three parties, mainly three parties. One, okay, financial market could be divided into capital markets, okay, and money. When existing, now both of them, okay, we know this is SEBI is the regulator, this is RBI is the regulator, this is for greater than 1 year, this is for less than 1 year. These are the main key differences. Okay, the issuers are companies. Here the issuers could be government or government departments or any municipality, etc. Now, when securities are issued for the first time, okay, so this could further be into two categories. One is primary market and the other one is called as secondary. What is a primary market? A primary market is where new securities are, and here when existing securities are traded. Okay. In primary market, company sells the security to investors and investors give the money to the company. When I go here in existing, investor gives it to another investor. Okay, so this is called as a trading. Company does not raise funds. Simple. Now we come to various participants in the market. Now we start with the first important exam questions. Who are QIBs? Now who are QIBs? An individual can never be a QIB. An individual can never be. So you don't have to learn anything. Pay attention to what I'm saying and how I'm teaching. They are buyers. So they are a buyer. They are buying shares. But these buyers are not individuals. They are institutions. They are what? Institutions. So institutions, can you tell me examples of institutional buyers? Mutual funds, government. Okay, so they are there. Now that list has been given, a pension fund. So these are proper companies, corporates, institutions that are purchasing in the market. Okay, so there it is an institution where there is a collective. Mutual fund is what is a mutual fund? So all the funds they collect from multiple people, it's an institution, and then they invest. So the institution is a collection of people, large number of people. They are called as qualified. Now many institutions can buy, but they're not qualified to be called as a QIB. For QIB you need to be qualified. Sir, what do you mean by qualified? I have to do CSEET? No. Qualified is you have to fall in the list that they have given you. So in your ICDR regulation, in your SEBI ICDR regulations, regulation number 21SS, they define what is a QIB. So they are telling you who all are qualified to be called as a QIB. There are separate rules for these institutions. So that is why we just need to know who are they. So I give you an example, mutual funds. A foreign portfolio investor, public financial institution, a bank, okay, your insurance company, provident fund, pension fund having a corpus of 25 crores, okay, your SIBD, your State Industrial Development Corporation, all of this. So a question was asked in the exam, okay, like I'm asking a question, system, NBFCs, etc. Is any other institution other than this list called as a QIB? Answer is no. QIB is the list is closed. Only the following are QIB. Right? And then SEBI will have separate rules. They say QIB. So this is what QIB. Very simple. Next. One of the categories of QIB we saw, they say that they are a foreign institutional, there is an investor for FPI, foreign portfolio investor. Sir, what are foreign portfolio investors? Again, as I didn't teach you what is the meaning of QIB, I'm not even going to teach you what is the meaning of FPI. I want you to apply your mind by breaking it down. So they are investors, obviously they are investors. They are not from India. They are from foreign country. So they are a foreign investor. But sir, we had done one concept that when foreign investor is investing in India, it is called as FDI. See, pay attention. When a foreigner, this is not given in your books, I am giving you extra knowledge. Okay, foreigner is making an investment in a Indian company. So whether it is FDI or it is called as FPI, the answer is, the threshold is given that if it is 10% or more, then only it is treated as FDI. If it is less than 10% in a listed company, less than 10% in listed company, then it is called as FPI. So again, this is not given in your book. I am telling you that if a foreigner is investing 10% or more, that investment is called as FDI. If they are investing less than 10%, that is called as FPI. That's it. Okay. I hope that is clear. They have told you there are two categories of FPI. Now the definition was not given because the definition is directly saying read chapter 2 of SEBI FPI regulations 2019. I have read, so I have told you the definition. Now that's not given here. What they have given here, pay attention. They have told you categories of FPI. So ideally a student would only know what is given in the module. They don't know beyond that. But I am telling you. Categories of FPI. There are only two categories of FPI. How many categories? 1 and 2. Category 1 and category 2. Now in category 2, okay, what they are saying, they are giving the clear list, okay, category 1 and 2. What doesn't fall under 1 will fall under 2. And 1, if you go to see, are very sophisticated, recognized, higher end bodies. Let's take an example. Imagine categories, that who is coming under category 1. So category 1 FPIs, okay, is government and government related banks. So government, big players, pension fund, university fund, when they also have funds, they also invest. If they are investing, they are coming in category 1. Appropriately regulatory institute. Appropriately means proper regulatory insurance company. Means they are regulated by some dedicated law of their country. So bank, insurance, okay, investment advisors, all this is coming who are regulated in their country. Very simple. So if you go to see the very sophisticated investors come in category 1. Entities. Now pay attention. Entities which are compliant with the anti-money laundering laws. Means if, now pay attention to the fourth category, who are there? If you are coming in a beautiful country which are following the money laundering laws, anti-money laundering laws, whichever is there, very good in combating money laundering, okay, then you will be considered as a category 1. So you are an entity, okay, of your member country, okay, member country of financial financial action task force coming under money laundering, which are appropriately regulated. Unregulated also it is fine, but whose investment manager is appropriately regulated. So one is either the fund is appropriately regulated abroad, or the fund. So always, even in the last part they've given, even in the last point, it is very similar, that you are in an entity, okay, whose investment manager is coming under, registered under category 1. So if your manager is good, okay, your manager is coming under category 1, the entire entity will also fall under category 1. Any university, okay, which has been in existence for more than 5 years will also come in category. Very, very simple, sir. Okay, exactly you can write, you don't need to write exact verbatim, but at least these points you can remember. Now, apart from category 1, whichever you can think of will come under category 2. So first is funds which are not eligible under category 1. So very simple, those who are not eligible under category 1 will come under category 2. Apart from that, family offices, individuals, okay, your unregulated funds of LLP, trust, your charitable institution, endowments, corporate bodies, appropriately regulated, okay, on behalf of their client, etc. But none of their managers are falling under category 1. So all other players will come under category number 2. Very, very simple, sir. We can write it, we can build it. Till now, two important exam oriented questions are done. Sir, which are those? One is who is a QIB, and second, who is a FPI. I mean, FPI, they have not given the meaning. They've directly said FPI is there, the regulation number they've given, the regulation name they've given, and they've told category 1 and 2. Question over. Then we see what are alternate investment funds. very important. So AIF are basically three categories. How many categories? Three categories. Okay, category 1, 2, 3. So there are three categories of AIF. Very simple. First categories are very good companies. Those companies which are early stage companies, or they are working for the welfare of the country and our country loves them. So they are very good for the India. Like, okay, your capital, like the venture capital, they invest in early stage companies. Your SME, they invest in SME, companies which are listed on SME exchange. Infrastructure fund. So they all come under category 1. Private equity, everything which is respect to new companies which we are investing will come in category 1. Then directly we skip to category 2 and we come to category number 3. Now category number 3 is, risk hai to isk hai, that line is there, okay, that higher the risk, higher will be the return. They invest in hedge funds. Hedge funds work with the concept higher the risk, higher the return, and they invest in complex derivative strategies. Okay, so complex derivative strategies. Normally, students, they don't, after reading also, they don't understand derivatives. Being a finance student, being a CS student, being a CA student, they sometimes people know what is the concept, but I've never traded. Imagine these players are dealing with complex derivative strategies. So they are all called as hedge fund managers, etc. They are category 3. Everything else which is not in category 1 and not in category 2 is in category number 2. So which is not in 1 and 3 will come under 2. And what comes under this, you will see that private equity fund, debt funds are the ones that will fall. Sir, if I want to understand what is a AIF, okay, I told you the three categories, very simple, you have to directly write it. The alternate investment funds. Now what is this? These are funds, okay, these are funds, fund houses actually. Let me draw the concept so you will understand. Okay? So an AIF. Okay. Now what do? They privately pool money. They do a private pooling of money from HNIs, from high net worth individuals. They go to big players who want to take higher risk, because they know higher risk means they can get higher return. So they privately pool these funds and then they invest. They invest as per the plan. Okay, then they invest in very different kinds of companies, strategies, early stage, etc. Now the question, and all the investors are also HNIs, high net worth individuals. They're investing at least 1 crore rupees. How much? Minimum investment is 1 crore rupees. AIF ad you will never see on TV. You will never see an ad on TV because they are not allowed to make a public announcement, public issue. They are privately placed. They privately send it that Ambani is there. Let's make him a part of our AIF. This this is the big guy is there. Gautam Adani. Let's get him and we'll tell him we'll invest in companies. Okay. Now pay attention. AIF is just like mutual funds. They are just like mutual funds. But mutual funds are for small players. You can make a public issue and all of us go and they invest in mutual funds. But this is mutual funds for big players. Big players are only, it's like a league of billionaires, where billionaires only are given entry because they are making the ticket size to invest is 1 crore rupees. Okay. And then they invest maybe in brand new companies, venture capital funds, all those. Clear till your concept, yes or no? So obviously they are not mutual funds. They are not mutual fund. They are not CIS. They are not any other thing. If you're falling under any of those categories, then you're not a AIF. For AIF, you don't have to be under any other SEBI law. Okay. And then we will read the meaning now. So very simple. it is privately pooled fund. Okay, and privately pooled from big players, whether in India or abroad. Okay, and they'll have to make an entity to get the funds. These funds could be made in the form of company, trust, anything you want, body corporate, whatever you want. This entity, this structure, legal structure could be of anything. It could be a trust where we are taking the money. We could take it as a company, we could take it as a body corporate, we could take it as a LLP. We can form it anything and then start pooling funds privately. Concept clear? Yes, sir. Which are presently not covered under any other regulations. Obviously, if it is mutual funds, etc., it will not be. It is those things. The definition is here. Important, any fund established in the form of any of these, any structure you make, but is privately pooled, okay, from India for investing as per the investment policy, and it is not covered under mutual funds, EIS, etc., any other. The following shall not be considered. Now they dedicatedly, this is not a AIF, okay, shall not be considered to be AIF. Like, there is a line that don't think that I am like you. Okay, we are different. If it is a ESOP trust, now employees, we are talking of big players investing, and then ESOP fund, these are all different. Holding company, special purpose company, securitization company, all these have a separate purpose. Family trust, all this is not an AIF. Common sense. Okay, then we did the three categories. Very thing good. Now in the three categories, extremely important, which is the best category that government of India will love, because these, once they pool the money from high net worth individuals, then they invest in beautiful little companies which help India. Like imagine in a startup, imagine today if we see that in India funding is available for startups and easy funding is available, don't you think India will grow much faster? Early stage companies, social welfare, social ventures, like combating air pollution or any social issue they are trying to do, social issue they are trying to address, SME companies, etc. All these are very good companies. Category 2, which don't fall under category 1 and 3. And category 3 is basically they invest in complex derivative strategies. Very simple. Done. Now, category venture capital. Okay, now venture capital, angel funds, etc. They are all category 1, which will come later. Okay, so here you can write one more thing. I want you to write one more category which they have not given here, but they should give, which are called as angel funds. Write it down, please. Okay, what they are called, because later it will come. Category 1, they are called as, very simple concept is also very simple. They are called as angel. So what are angel funds? Angel funds is a special category of category 1 of AIF, which invest in brand new companies which are in the seed funding is given. Okay, in the early stage company is given. They are investing at the ideation stage. So the investor is like an angel to the company. That's why it is called angel investor. Now this is all very simple. We can quickly move through. What is venture capital? You can write it is a category 1 AIF. Okay, they invest in early stage companies. Same whatever we said. Okay, mostly in early stage companies. Okay, and mostly they are in private companies. Common sense, because they are new, so they are just starting off, so it will be privately companies. Okay, and they help for involvement in new products, technology, etc. Include a angel fund, as I made you write above. So it is means an AIF which primarily invest in unlisted companies, because they will be listed is a big company, startups, emerging, everything is similar. Okay, so venture capital is a group of investors who pool the funds on basis of certain parameters. Very simple. Now we come to private equity. Now this many people don't know about private equity. Private equity. Now how to write what it is? They are called as PE firms. I never tell the student to mug up. I teach them exactly what they need to know. So private funds, private equity, what do? there are investors. Who are they? They are investors. Obviously, private equity are investors who invest in, pay attention, unlisted, okay, private companies. Okay, obviously, private companies will be unlisted only. So, unlisted companies, mostly private companies. Okay, unlisted could be a public company also, but they invest in unlisted private companies. Okay, and mostly in their equity shares. Means equity shares is high risk, so they will invest in this high risk equity shares at early stage. Why? Because they believe in the growth story of that company. They believe this will become the tomorrow's Microsoft, tomorrow's Apple. Okay, so that is why they invest. Now obviously when you invest, now think of from an investor point of view. If I invest in a private company, okay, at an early stage, I am obviously going to be illiquid. It's very difficult for me to find another buyer. If I'm investor, means I have to stay for long term. So they are also investing for long term. It's not like today I invest, tomorrow I can sell, because it's not traded on stock market. So this keywords you can remember, you're done. You're investing in equity shares of companies which are not publicly traded. Okay, and they mostly, you will never invest in a unlisted public company because risk is very high. It is only high net worth individuals will invest. Okay, and obviously when they invest, their money gets blocked. It's only money will get unlocked when that private company gets converted into public company and goes for IPO. Okay, then comes type of private equity. Now types of private company, very simple, very easy. Venture capital we have already done. They invest in private equity. Okay, so equity shares they invest mostly in less mature companies. Second, growth capital. Do you require me to explain what is growth capital? Growth capital means what? Today, if a company is coming and saying, I want an idea, I have an idea, please invest. That is not growth capital. Growth capital is when you've started, shown your minimum viable project, and now you just require funds to go on larger scale. So, you're looking for capital to expand, enter into new markets. Okay, you want to do major acquisitions without controlling your business, that is called as growth capital. Clear? And then the last thing comes called as leverage buyout. So I did the second and the third because they were easy from what we've done. Venture capital we did above. Growth capital is a capital to expand. Very simple. It's a capital to expand, enter new markets. Okay, do a major acquisition without change of your control. You just want to acquire them. Now coming what they can ask you in the exam, because in the exam they've also asked types of private equity. Leverage buyout. Sir, what is leverage buyout? For this, I don't tell the students to learn anything. I just tell them in English what word you need to know. You just need to know leveraged. What is the meaning of leverage? A loan. Leverage means a loan. That's it. Now you will be able to crack it. Because if you don't know the meaning of leverage only, you will not be able to understand leverage buyout. So leverage buyout means a loan you have acquired by use of financial leverage. Means the equity shares are acquired through loan. Through, that's it, done. Question, concept done. What is happening is a strategy to make the equity investment in the company through financial leverage. Financial leverage means a loan. Okay, so they are typically an investor who's taking such amount of risk that I'm taking a loan to invest in the company. So it's an extremely risky, activity to do. Then comes angel funds. The angel fund I had done somewhere, I forgot. I just told you above in category 1. What did I tell you? In category 1 AIF to write something. What did I tell you? That in category 1 AIF. Write the word angel funds. Sir, what are angel funds? So first line you will write angel funds are category 1 AIF. What will you write? It is a subcategory of AIF. Category 1. Done. They're very easy. Next. Yeah, angel. An angel is a guy who's come down from the heaven to help you. Here also, this is one high net worth individual called as an angel investor. So maybe an investor like Ambani, you met Ambani in the elevator. You've heard something called as elevator pitch. Like for founders, it is always told that learn a elevator pitch. What is the meaning of elevator? Elevator pitch. Elevator pitch is basically you're meeting any guy, and in the elevator you should be able to pitch your entire business to him. That small, 1 minute max, 30 seconds if you can give that pitch. So that's called as an elevator pitch. Now imagine you met Ambani in the lift and you made the elevator pitch to him and he liked your business. He calls this guy that whatever he wants, fund him. He came as an angel investor to you. So he's a HNI. He's an all HNIs only come in AIFs. Okay. HNI who is ready to invest in the starting stage of the company. So they provide what? What do they give? Obviously capital funding. Okay. They invest in equity investment of startup companies. Angel investors help to shape the models. Obviously, when they are investing, they will not only give funds, but they will also direct you on business plan, on marketing, branding, what all things you can do better. So they act as incubators. What do they act as? Incubators. Incubators give you a incubation. A child is put on incubation, means they are given life support. All the resources are also given by the angel investor. Now we come to some financial matrix. Now pay attention. Now angel investor, and now we finished with angel investors. Okay, angel investors and angel funds are done. Now we come to the next concept. Now this is the next concept. This is called as anchor investors. Mark this also as important. Sir, what do you mean by anchor investor? Now imagine if I'm making an IPO, I'm making a public issue. I would want people coming giving me 100, 200, 300, 2 lakhs, 3 lakhs, and one guy is come directly with 10 crore rupees when 10 crores or more funds. So for me, he has anchored my entire issue. So anchor investment, anchor investment means a QIB. Obviously, this kind of money is always given by QIBs only, qualified institutional buyers. Okay, so it is by QIBs who make an application for at least 10 crore rupees on the main board. So they make an investment of how much? 10 crores or more. So you are an anchor investor, big investor. Just write the word anchor is what they have really anchored or supported your entire ask. 10 crores and on 2 crores or for the SME stock. So if it is main board means what? NSE, BSE, and SME stock exchange, it is 2 crore or more. Right? Now, they've given you some rules of how many anchor investors are needed. Okay, now pay attention. Allocation to anchor investors shall be on discretionary basis subject to the following. Means it is my wish if I want to allot them or not, I don't have to allot them. Not mandatory, it is on discretionary basis. So anchor investors, we can give them on my wish on the following category. So now in case public issue is on main board, so what are the thresholds we will see? If the issue is on a SME board, we will see what is the threshold. Okay, very simple. I have made a very simple table. Okay, you have to take a screenshot of this and exactly write it there only because it's very, very simple to understand. Suppose if I want to allocate up to 10 crores to anchor investor, I have to get maximum 2 such investors. Means I'm saying that these guys are anchor investors, they are giving me 10 crores. So for the first 10 crores, at least 2 people should come. If it is more than 10 crores to 250 crores, so imagine I'm getting more than 10, 20 crores, 30 crores, 60 crores, 100 crores they are getting. So then they say minimum how many anchor investors have to get 2 and maximum 15 with minimum 5 crores per investor. So if someone is coming to give me 20 crores, then I will come in category number 2. I have to get minimum 2 of such 2 people who will give me this ask, and maximum 15. So minimum maximum they've given you, and always it will be minimum 5 crores per investor. If it is more than 250 crores, so imagine if I am saying that I will allocate, I will give to anchor investors 300 crores. For 300 crores, minimum 5 have to get, maximum 15. Okay, and an additional 10 such investors for every 250 crores or thereof. So as 250 crores, for the first 250 crores it is 5 to 15, and 10 additional investors for the next 50. So then next 250 again 10 investors, so on. So if I tell you that there are 10 crore rupees coming, so how many investors I need to get? Maximum 2. If I tell 20 crores I am getting, 20 crores I want to give for anchor investors, so I need minimum 2 and maximum 5. Now if I tell you I want to give 1000, let's say 500 crores, 500 crores. So the first 250 crores, minimum 5, maximum 15, this much, and for additional 10, so once you go more than 250 crores, additional 10 investor crores for every 250, additional 250 crores. First 250 crores they've given you, same as above. Then again 250 crores, then you have to add 10 more. Okay, simple. Then similar thing is there for SME stock exchange also. Now they start with 2 crores. So you can remember like 2 crores, 25, and that's it. Okay, here you can remember the threshold is 10 and 250. So you can remember 3 categories, right? So 0 to 10, 10 and 10 to 250. So this is the first category, 0 to 10, 10 to 250 is one, and third category is beyond 250 crores. Here if I see the other thing is similar thing I will make here also. So it becomes easy. Now this is just a number game, okay? Just you have to just remember the numbers threshold. Logic is very simple. 0 to 2, then 2 to 25, and then more than 25. So this is category 1. If allocation I am doing this much, I require maximum 2, and this number is same. This number is same. Okay. So if it is from 2 to 25 crores, then I have to get minimum maximum. They've given you how much, and then third category is clear till here. Now anchor investor. Now pay attention to this. Okay. Now this is also important. Now imagine, have you invested? If there is a big investor coming, there are people giving you 50,000 rupees, 500 rupees, 2 lakh rupees, and one guy suddenly come with 20 crores. So what they say, all these big players who are there, we will call them as VIP, and we will give them VIP treatment also. We will not make them stand with the normal people. We will tell them we are identifying you as something. What are you identifying me? As a anchor investor. For anchor investors, bidding will start one day prior to public issue opening date. So imagine if a IPO, this is the issue opening date for public. Okay, general people are, this is the issue opening date. Okay, anchor investors will come one day prior. Anchor investors will come one day prior. Okay, one day prior, we will allot it to them, and we will bidding one day prior we will take to public, and allotment also on the same day. And second, we keep a lock-in period of their shares, because what is happening is the people will say, listen, Anand Rathi has invested in my shares, XYZ big player has invested in Ramesh Damani has invested in my shares. So they are anchor investors. Their name is also normally used to drive public into investing the IPO also. So now pay attention, okay? Now anchor investors. So you have bidding for anchor investors shall open one day before it is opening for the public. And not only that, the shares shall be allotted on same day, completed on the day of bidding only, issued one day prior. So imagine like this, we invest in some kind of west side or something, they give you this, that you are our premium customer, one day prior you come and you take the sale material, and same day we will close it also. That is there, and shares allotted will be locked in for 30 days, right? This is important. Now up to 60% of the anchor QIB portion shall go to anchor investors, and one third of the anchor investor portion shall be reserved for domestic mutual funds. Sir, what is this? Now pay attention to these thresholds also. Now let's say I'm going to explain this. Okay, so you have these thresholds, tell me whether you understood. So this part I've completed. Second, this part is 60 and one third. Mutual funds will be written here. Now, if this is the entire public issue, if this is the entire issue size, okay, if this is the entire issue size, so imagine I want to make an issue of so big, I will say from here, this much I'm reserving for my VIP people, my QIBs. So let's say from here, 100 crores I'm reserving for whom? And this entire 100 crores is reserved for QIBs, right? From this anchor investor, QIBs, from here 60% of the portion of available shall be available for anchor investors. So what we have kept for QIBs, 60%, because see, when you go to see, QIBs means any institution, mutual fund could give 1 crore, 50 lakh rupees, that can also come. So here we are talking of QIBs who are investing 10 crores or more. So from here 60% again is reserved for whom? Is reserved for anchor investor, right? So how much? 60 crores is invested for anchor investor. So if this is 100 crores, we will say from here, okay, from here we are saying let's say 60%. So this much, this entire part is for anchor investor. So what did I do? 60% of QIB portion. So this entire thing is QIB portion. 60% is reserved for whom? Anchor investors. Now when you go to anchor investors also, anchor investors could be any QIB who's investing 10 crores or more. So it could be anyone, any big AIF investing, they will also come here, or any big investor coming. Here they are saying from the anchor investor portion also, 1/3 shall be reserved for domestic mutual funds. How much? 1/3. So what is 1/3 of 60 crores? 20 crores. Okay. So 20 crores from here. So let's say this much portion. How much is the anchor investor portion? This much. From anchor investor portion also, this much will be reserved for whom? For your domestic mutual fund. Concept clear? Yes or no? Very, very simple. They can ask you. Now pay attention. Now you read it. It will be very, very okay. That first we have to take the QIB portion. So whatever is the QIB, 60% of that will be reserved for anchor investors, and whatever is reserved for anchor investors, 1/3 of it will be given to domestic mutual fund. Simple. We are done with that. Then we come to high net worth individual. 100 times I've said high net worth individuals. Sir, what do you mean by high net worth individuals? So high net worth individuals means 2 crore rupees. Individuals who have over 2 crores surplus money. 2 crores investable surplus is called as HNI, and emerging HNI is also there. Emerging HNI is basically those who are investing up to 20, have investable wealth. They have investable, they can invest up to 25 lakh rupees to 2 crores. They are emerging to be a HNI. Then comes pension fund. Sir, what is a pension fund? Very simple. The government of India, okay, has made pension fund where any government employees are there, private employees for whom pension is being cut. They are from their salary, it is cut, then deposited where? The employer has to deposit in pension fund. Now imagine pension fund has so much money. They also will invest somewhere. That is called as a pension fund. The employer and employee contributions, government takes their contribution, they put it in this fund. This fund can invest everywhere. So pension fund means a fund established by the employer. Okay, and he will have to give it at this pension fund will be given at the time of retirement, but till then it has to be invested somewhere. It will be invested in the pension fund. Okay, this is for long term growth. Pension funds are commonly run by some kind of an intermediary. Okay, so pension funds have relatively very large amount of capital. They play a huge role in the economy because they have so much funds to invest. Okay, now there are 3 legislations for pension funds. You have your Gratuity Act, you have your Coal Mine, you have your MP Act, okay, Provident Fund Act. All these acts tell that you have to deduct pension. Formal sector is there, obviously, where government, etc., government pension is there. Informal means for unorganized workers also pension can be made by private organization, which is very rare. Okay, then with this we come to the next segment, which is called as capital market instrument. Now in capital market instruments, we know there are 2 kinds of shares which are there, equity and preference. Now equity will be we know the concept, with voting rights and with differential voting rights. Okay, let's get into what is important. Okay, now come to this part, very 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 important, regularly asked in the examination. So section 43, read with rule 3 and 4, they talk about shares that are being issued with differential rights. Means you can give more voting rights, more dividend, priority payments, all of that can be given on certain shares. Now when can you issue these kind of shares? The criteria is being given. So Tata Motors who had recently issued DVRs. Now for that you have to ensure 2 things, 3 things actually, to issue DVRs, differential voting rights. Can you tell me which kind of resolution is required? Answer is ordinary resolution. Ordinary resolution, 51% consent, and you can issue DVRs. Second, you should not be any default. Imagine I'm issuing these kind of priority voting rights, differential voting rights, and in my company is only defaulting. So say till the default is there, you cannot do such kind of DVRs. Third, and default could be with respect to loan repayment, employee dues, etc. And third is the maximum amount of DVRs that I can issue. Maximum DVRs. So can everyone in the company have exceptional voting rights? It will be limited, right? So company will have mostly normal voting rights. Very few shares will be issued with differential voting rights, that on these shares more voting rights are there. So the maximum limit government has set it as 74%. So the max that we can issue DVRs is how much? 74% of the total voting power. And the articles must authorize. So also AOA should authorize. Very simple, ordinary resolution, and you should not have default. Very simple. Preference shares. Now sir, what are preference shares? They get preference over equity at the time of dividend payment and at the time of repayment of capital. Now section 55 says that they can vote, they have limited voting rights, they can only vote on resolutions which affect them or in their meeting, class meeting. However, if for 2 consecutive meetings their preference dividend is not paid, then in that case they can attend and vote on all the resolutions. And in 2 years have we not got dividend, we will vote on all the things allowed. Okay. Kinds of preference shares, very simple, don't expect it to come. Even debentures, I think we have a in company law. So section 2 subsection 30. So one thing you have to understand, that debentures are debt. They is like it's a acknowledgement of debt. Okay, and they come under section 230 and section number 71 is the provisions given. Okay, convertible, non-convertible, partly convertible, all those debentures are there. Optionally convertible, to whom the option is being given. Investor has been given an option that if he wants, he can convert, he can not convert, so etc. Very simple. Now we come to types of bonds. Now pay attention to this. Okay. Now from here, two kinds of bonds are important. Bonds are important. One is masala bonds. I'll say three kinds of bonds are important: masala bonds, municipal bonds, and foreign bonds. Foreign exchange convertible bonds, foreign exchange exchangeable bonds, etc. are important. Let's see. First, let me explain what is the meaning of the term bond. It's just like a debenture. Just like a debenture, a bond is issued. Let's say government bond is issued. They will tell you for 5 years is you have to pay the principal now. Give us the loan. Let's make a example and close it. Okay. So here we have the issuer, and here we have the investor. Here issuer has issued the bond. In return, the investor has paid the money to the issuer. Now the bond will have a life like maybe 5 years. In 5 years, the investor will get interest regularly and at the time of redemption. Redemption means redemption on maturity. So when it will get matured at the end of 5 years, your principal amount will be given back. So during the entire life, you will, so if it is for 5 years, 1, 2, 3, 4, 5, you will keep getting interest every year, and in the end you will get your redemption value. Simple. So bond is like a loan. I have taken a loan. Okay, well, I have given a loan to the company. If imagine the company has issued the bond, the company will have to keep paying periodical interest, and in the end they will pay the principal amount. Okay. Okay. Now, types of bond, government bonds, is bond, tax saving bonds, headings enough. But which are important, I told you, is masala bonds, which is rupee denominated bonds, foreign currency convertible bonds. Now pay attention to this. What is foreign currency convertible bonds? And they've only given FCCB. Then they've also said, can you distinguish between FCEB? Okay, let's see. Let's finish it off. So if today, pay attention to this. What is happening is, do you know that in India the interest rate is high or abroad? In India the interest rates are high, or in abroad, in Dubai and USA the interest rates are high? Obviously in India. So taking a loan in India, I have to pay a lot of interest. So what happens? Maybe a Indian company wants to go and issue the bonds abroad on the New York Stock Exchange. So they can't go directly. They have to first place, there is a placing of securities. All the bonds, like your foreign currency convertible bonds and your foreign currency exchangeable bonds. There are two kinds of bonds. I want to issue abroad. The Indian company, I want to issue these bonds abroad, take a loan from abroad. Okay. So in that case, I want to sell these bonds to foreigners. So I cannot directly sell it. What I need to do, I have to catch an intermediary. An intermediary will be a domestic. Since it's in India, it's a domestic custodian. So I give them the custody of my bonds. Now just remember your bonds. Okay. And these intermediary will then again connect with a foreign intermediary, like how we have depositories here who hold shares in electronic form, trading is done in electronic form. There also they will catch a overseas depository, they will connect with them, okay, and then they will issue the bond. They will issue the bond to the foreign investors. Now, what is the speciality of this bond? Pay attention. Being a bond, now the features, I want you to note it down. Features. Now this is same for both. Each word I will break it down. Okay, bond. So in a bond, what happens? There is a interest. There is always interest given. In a bond, you have to give interest during the life. Now forget, only difference is your convertible and exchangeable. This I will tell you separately. But second, it is convertible. So they can be converted into equity shares. So it can be converted into equity shares, just like how we have convertible debentures. These are convertible bonds. So these can be converted into equity shares. Okay, equity shares, it can be converted just like a convertible debenture that we are issuing. And it is foreign denominated, means it will be denominated in foreign currency, So 3 points are over from these 3 words. Foreign means they are denominated in foreign currency. It's a bond, means interest will be given, and these are convertible. Now, convertible and exchangeable, foreign currency. Okay, now we will see foreign currency convertible bonds and foreign currency exchangeable bonds. Now pay attention. In convertible bonds, what happens? Here, just like debentures, you get converted into the shares of the issuing company. So this is the issuing company. So here you get the shares of the issuing company. Equity shares, when you convert, you get shares of the issuing company. In exchangeable bonds, you don't get shares of the issuing company. Instead, the issuing company will have their subsidiary called as offered company, which might be a group company. Offered company, which is a group company. They are a group company. So what will happen? You will get shares of the offered company. So in exchangeable, when the foreign investor converts it, it will not convert into issuing companies. Instead, it will convert into the issuing company's group company, which is technically the offered company. So issuing company will say, listen, I am Reliance Industries. If you all convert, you all don't get shares of Reliance Industries. You will get shares of my other company, which is Reliance Jio. Are you interested? If the foreign investor is interested in the subsidiary, believes that this subsidiary can grow really fast, and he will invest. Very simple. Done. Okay, so what I have done exactly is what you have to write, and your job is done. Okay, don't have to write anything else. Same logic. Okay, so these are bonds issued by whom? Indian companies are issuing. Okay, which is expressed in foreign currency. Since it's a bond, principal and interest will be paid. Okay, and it will be paid in dollars. Okay, 25% can be used for restructuring, money that we get where this Indian company can use that they given. Then comes exchangeable bond. So everything, it's a bond, it is exchanged in foreign currency, principal interest will be given, issued by the issuing company, but subscribed by a foreigner. Only difference is you get exchange into the shares of another company called as a offered company. That is it. You can write in your own words. I've explained. You can even draw what I have given. Now we come to the next concept called as Indian depository receipts. What we are doing? Indian depository receipts. Sir, what are Indian depository receipts? Imagine, as we can go abroad and raise funds and tap an international market and raise funds, that reverse is also possible. Where a foreign company wants to raise funds from India, this same flow will just be reversed. This same flow will be reversed. So let me explain. This is about We tapping international markets. Now pay attention to this same thing. Now think that there is a foreign company, and there is one company which had done this, which is called as Standard Chartered. Now we are talking of NSE BSE. We are talking of NSE BSE. This is an Indian stock exchange. There is a foreign company. There is a foreign company which is a issuing company. They cannot go directly and get listed. They have to follow some steps. They have to engage some intermediaries. Now pay attention. They will hire for us, they are overseas custodian bank. They will be a overseas. They will have to give the custody of their shares or the bonds that they want to issue. Overseas custodian bank. This custodian bank will talk with our Indian depository. They will talk with our Indian depository. Okay, and when we are as Indians, okay, it will be denominated in rupees because it is being sold to Indians. Now we are a Indian. Okay, so when an Indian will subscribe, this depository will issue a receipt. On payment you will get a receipt. That receipt is called as Indian Depository Receipt. It will evidence. So it is issued by, Indian Depository, right? And what does it evidence? And it will be in rupee terms. It will evidence that you own shares of foreign company. That's it, concept done. If you want, I buy IDR means what? I have a receipt issued by Indian Depository that you are holding shares of a foreign company. Concept over, done. Now pay attention to this. Any instrument in the form of depository receipts created by a domestic depository, okay, it will be denominated in Indian rupees, created by a domestic and it will show that you have shares of a issuing company which is a foreign company, so that foreign companies can raise funds from the Indian securities. Here, done. So they will have to follow, since it's a foreign company, they will have, when they're raising fund, they will have to open an office, inform RBI. Section 390 is about foreign companies, registration of foreign companies. Okay, that has to be done. Now derivatives, what are derivatives? Pay attention, I have taken an entire in-depth sessions on sums. The theory of derivative doesn't come in the examination. What comes is the sums. I have covered this entire thing in the sums folder. You can get it from the dream batch or our regular lectures where full sums are covered. But in short, I will still tell you what it is. So derivatives is basically a contract. What is derivatives? It is a contract whose value is dependent on underlying securities. I'll give you an example. It's very simple. I have invested multiple times in derivatives. You go to my Instagram handle, you'll see I have invested in all kinds of derivatives, whether it be forwards, futures, in futures also, call options, put, everything, all the derivatives I've done. But let me tell you what it is. So I'm giving an example of currency derivatives. I'm giving an example of currency derivatives. What is currency derivatives? So I bought a dollar. Now I have not bought physical dollars. I have just bought a derivative. I bought $1. If the value of the dollar goes up, my value will increase. If the value of the dollar goes down, I will lose the money. That's called as a currency derivative. I've just imagine virtually I have bought a currency. If it goes up, I earn. If it goes down, I lose. Okay. So what is happening here? The underlying asset is a dollar, is a currency. So the value of my contract, how successful I am, will be dependent on the underlying performance of the underlying security. I have also done commodity derivatives. Sir, what is commodity derivative? So here you purchase it's not a real buying of thing. It is just a virtual buying. I take a position. It's just a position taken. So I went and you go for commodity derivatives. You can buy gold, you can buy silver, you can buy copper, you can buy aluminium. you can buy zinc, you can buy all this I have traded. Okay, so you buy, and let's say if I feel that the price of silver will increase, I'll go and buy silver. That's a commodity derivative. If the price of silver actually increases, so the performance of my contract, okay, will depend on the performance of the underlying asset. So in future, these are all related to futures, because in future only I will come to know whether I'm successful or no. Clear till here? So derivatives are a contract whose value is derived from certain underlying asset. You can even take stock derivatives. I mean, you can even take a bet on Reliance, that Reliance will increase. If it actually goes up, the differential amount you will gain. For example, I took a bet on Reliance of 100 and the value went to 120. So the price was 100 and it went to 120, 20 rupees will be credited in my account. Simple. So the sums I have taken in depth. Right now, just explain you the concept. So there are 4 kinds of derivatives: forward, futures, currency, swaps. Now what is warrant? Warrant also, there is a sum on it. I have taken it. It's very similar. A warrant also gives you an option. Okay, it is an option that if you can purchase the warrant. On purchase of the warrant, you get an option to buy the security at a certain price in future. You get an option. If you want, you can buy my stock at 50 rupees. If the price is more, then you can purchase at 50 only. But if the price is less, you will say, I don't want to execute, I don't want to do that. So some price has to be given at the time of starting the contract, which is called as maintenance, initial maintenance margin has to be given, etc. So those are covered in the sums right now, not explaining that. Coming to another important concept called as REITs. So what is REITs? It's an extremely important concept. It's an extremely important concept. Let me explain what it is. Today, we know that the price of real estate is only going to go up. Okay. Real estate, though there are some minor fluctuation, but in the long run, real estate prices will only go up. Okay. 100%. In the next 10 years, the prices will be more than what it is today. You know it, I know it. But when you know it's surely going to go up, why don't we go and buy? Because the ticket size is very big. It's very expensive to buy real estate. So to solve that problem, REITs were created. So REIT, now pay attention what it is. So a REIT, real estate investment trust, is a form of a trust created. Okay. In the trust, you will have sponsor who has set up the trust. Sponsor is the one who set up the trust. You have an investment manager who will manage all the investments. Okay. They'll decide which property manager, etc. will be there. There will be trustees to protect the interest of the unit holders and the investors. Now pay attention. A REIT is created. They will pool in money. They will pool in money from investors like you and me. Even I have invested in REITs also. You can go also and invest in REITs. Now when you buy, so there is Park, Indian Embassy, I think, different kinds of REITs are there. Embassy Park REIT is there. You can go, you can purchase. Once you purchase a REIT, just like a share, okay, or like a mutual fund, and it's traded on the stock market. So what happens once you give the money? So they pool the money from investors, and after pooling it, they will invest in real estate income generating projects, income generating properties. So income generating property. So which kind of property? So Embassy Park, they invest in corporate offices. They invest in corporate offices. Some can invest in, you can say, malls. Okay. Some would buy land. So any of this can be done. Okay. They could invest in all these constructed properties, under construction properties, etc. So once we give money to REIT, is dedicated to invest in real estate. From this, when from this income generating property, rent is earned, capital gains is earned, then this is given back to the investors. So they get the gains. So this is how it typically works. Infrastructure REITs are also same, but only difference is they will invest in infrastructure projects, maybe a land, maybe like a road being built or a toll. From toll they will keep getting money. Okay, all those things are there. Similar concept. Pay attention. So what is the benefit of a REIT is that investors who don't have much money, they can all come together, contribute, and then buy income generating real estate. Finish. Okay, so you can start investing in real estate assets from today with lower capital. Okay, so less capital investors, good for small investors. There is transparency. You come to know whether how much is the value. You can sell off, easy to sell, and you get dividends. Regular dividends are given because moment that income generating properties generate rent, it is distributed among the people. Okay, fast appreciation, easy to buy. Same thing is with same structure. Only the category in which we are investing, they are investing in infrastructure projects. Okay, they will earn from the infrastructure sector. I told you the parties, it is same for all sponsors, investment manager, project manager. Okay, now they say that the sponsor should have at least this much net worth. So who is a sponsor? The person who starts the REITs or the InVEETs infrastructure. Okay, so they have to hold, they at least have to buy 15% and it will be locked in for 3 years. Then comes to the next thing called as securities debt instrument. Very simple concept. Okay, now you will see it is backed by mortgaged, commonly debt. The process is called as securities, mortgage backed securities. Lower interest rates can free up the bank, okay, and encourage lending. Now let's see, I'll explain this concept also. Very simple. What is the concept we are looking at? Securitized debt instrument. Now what is securitized debt instruments? Pay attention. Banks, okay, are there. They have many daters. Or I could say a debtor must have taken a home loan. Okay, now pay attention. You can write this diagram, you will understand this. Now banks, what happens is they've given a home loan, so the debtor has to give security. The security itself is the house. House is the security. Okay, he is given. In return, bank has given him money. And the debtor has to regularly pay what? Principal plus interest. EMI basically, I just call it as EMI. Regularly he will have to pay. That EMI includes both principal and interest. The bank gave them the loan. Now think from the bank point of view. Such a big amount of loan they have disbursed and they will get over 20 years they have to wait to get their money. So then the banks, what they do, they try to sell it to certain companies. Okay, now this is not there in your syllabus, but still I'm telling you, they are called as securitization companies or asset reconstruction companies. Now they are made, the banks sell the debtors, sell the home loans. Now home loan actually is nothing but a mortgage. The bank says that listen, you pay us some amount, we will get out of it, and then they will start paying it to you. So the securitization company comes in the position of the bank. The bank just gets, if the bank has given a loan of 2 crores and they are expecting 3 crores back from the debtor, they will tell anyone giving me 2 crores 50 lakhs, I'm ready to sell off these debtors. He will keep paying you for their entire life. You are very secured and safe because the asset is properties. He has given, the bank never goes in loss because they have the, if nothing is, you can't pay, they will take the home loan, they will take the house. Okay, so securitization companies there. Now these securitization companies obviously buy these pool of mortgages they purchase from the banks. Where these companies, and this is also business, how do they get, because they know that they are buying it at discount. So this discount is their gain. So they issue this securities to the public, to the HNIs and common public investors. Okay, so investors are there. The investors, they raise the money from IPOs, public, etc., and then they purchase from these banks. Now, they will give them return on their investments, capital gains, etc., and the HNIs on there. Okay, they give them in, funds are given here. So when the securitization company is receive these funds from the HNIs, they will issue something called as securitized debt instrument. What they are issuing, the name of that instrument that a securitization company issues is securitized debt instrument, which signifies that these are securities which are debts. Actually they are mortgage debts, and that is why they are called as mortgage backed securities also. So they are also called as mortgage backed securities. So whenever I invest in a SDI, securities debt instruments, I know that I am purchasing an instrument, which loan I am purchasing. Someone must be going to pay the loan. If they can't pay, the asset will be sold. So all of us come in the position of the bank. Very simple. Now you read it will be very, very simple. So these are securitized individual debts. They are backed by assets, we know. Okay, why backed by assets? Because that house is there. Okay, they have lower interest rates and free up the bank. So for the bank, they are locked capital gets unlocked. So this really is good for the banking. Okay, then I told you another very, very important is municipal bonds. Sir, what are municipal bonds? Municipal bonds are bonds issued, that is a loan taken by municipalities to build roads, infrastructure projects, etc. On that, they will have to pay interest, etc. That's it. These are also called as muni bonds. Okay, they are issued by government and government bodies. Okay, for mostly for infrastructure projects, airports, railway stations, etc. Bangalore Municipal Corporation was the first one to issue it in India. Okay, you should meet now. Even the municipality now, since they are going to take a loan from people, they also cannot just do if they have eligibility criteria that they should not have a negative net worth, they should not have defaulted. Okay, they should not be listed in a willful defaulters published by RBI. Then they can take the. With this, we have completed the entire lesson. Thank you. Hi, so we start with the second chapter, which is called as secondary market in India. Now, first we talk about the stock exchange in India. Now, the stock exchange in India, which was in 1875, that was the BSE when we was launched, and in your 1992, so we had in 1875 we had our BSE. Then in 1992 we had our NSE. Initially, when we started off, we are the oldest stock markets in Asia. We had started under the banyan tree. So in actual practice, there was under the banyan tree. Then we had our iconic tower in your BSE, and now it has grown into both NSE and BSE have grown to be in the top 10 largest stock exchanges of the world. Okay, BSE is there and NSE was granted in 1992. Now, if we go to see just the stock market, so what is exactly a stock market? What is the job of a stock market? So a stock market, and how do I get registered by setting up a stock market? So here a act is there which is called as the SCRA Act. Anyone wants to be like set up a stock exchange, they go under the SCRA Act, take central government approval. Okay, so they go and they take a central government approval, and then they can set up a stock exchange. Now, what does a stock exchange do? Very simple. If you've ever traded, you know that it is a marketplace for buying and selling of securities. When we buy, sell, okay, securities, it gives companies liquidity, that is funds. And we are easy to sell. It's easier for us to sell the securities as well. Now, what is the role of a stock market, stock exchange? They should ensure that there is a smooth trading of securities. Second, it should ensure that the savings are converted into investments where we want to we have a savings, we invest it. So their job is to ensure that they give a proper platforms where the entrepreneurs can show their worth. Okay, so they act as a continuous monitoring, as a monitoring activity will be done whether it is functioning properly or not. Okay, so their job is to protect the investors in the stock markets. We have SEBI, Security Exchange Board of India. One important line is there that it acts as a barometer. So always a stock market is treated as a barometer of the stock exchange, knowing whether how healthy the economy is there or not. Okay. Now, stock exchange, we saw BSE came into existence in 1875 and NSE came in 1990. Now, initially all this is very basic, it's not expected to come in your examination, or all these topics get covered later on. We will start with the real topics that come in your examination. So just you can write that the trading mechanism is there, that you normally the trading cycle is T plus 2 days, but now SEBI has said that T plus 0 days also they are introducing. T plus 0 days, that is on the trading day only it is settled, which is most of the time I buy, sell, I get the securities also, money is also debited same day. Now this is all happened due to online demat accounts, etc. Okay, so section regulation 40 of the SEBI LODR says that the transfer of security shall not be processed unless it is in demat form. So we will be seeing regulation 3 important laws now. Regulation 40, pay attention to what we are seeing. Regulation 40, Rule 9A, simply saying that nowadays physical trading is stopped, is banned, is not allowed. Both regulation 40 applies to SEBI, that is listed companies. They are saying that it has to be there in dematerialization form, only demat form. Rule 9A also says the same thing. Okay, so let me tell you that all companies, whether it be listed or whether it is a public company or whether it is a private company, all of them, okay, all of them have to issue securities in demat form only. Okay, where it is given in a regulation 40 of SEBI LODR. You can quote it in your examination, and in your Companies Act, your rule 9A of the Prospectus and Allotment of Security Rules 2014. Only one exception is there. Exception is there for small companies. So small companies who are there, okay, small companies who are there, they can issue securities in demat in physical form. So physical share certificates can be issued by private companies who are not meeting the thresholds. They can go ahead and issue. Rest, every single company has to issue securities in demat form. Now just one small little concept till we come to the real chapter. Listed securities. Sir, what do you mean by listed securities? Listed securities means your securities, your shares are listed on a recognized stock exchange. They have listed on a recognized stock exchange, and with the company must have had an agreement with the stock exchange that, listen, I want to list my security so that it can be traded by anyone in India. That is called as listed. Permitted means what? That the stock exchange has permitted you. Maybe you are listed on NSE and now you're coming on BSE. Procedurally, matter is pending. They will say, okay, fine, till that is there, you can trade here also. So here, to facilitate the market participants to trade in securities which are actively traded on another stock exchange. So you are actively traded in NSE. Now in BSE you are not listed. So we may permit you to be listed on BSE also and get traded. Okay, provided you later take the consent, all the approvals, etc. Market participants only headings. Who are there? We've done it 100 times. Who all are there? One is the investor, that is who come, you, me, companies. Then comes the issuer who's raising the funds, and the third is intermediaries. Intermediaries are your brokers, underwriters, portfolio managers, all of that. Separate chapter is there, so don't have to go in depth now. Okay, stock exchange, depositories. Depository also there's a separate chapter, you don't have to go in depth from here. Brokers, custodians, merchant bankers, all we will have. Now we come to one concept which from now actually the chapter starts. Till now what we did was just like about understanding the stock market. So the stock market is there and what is the role of the stock market. Now we come with exam questions, that what can come in the examination. So this is the first one, important question, that exchange traded funds. Sir, what are exchange traded funds? Imagine, and this is what I always recommend to the students, that not recommend as in I suggest that if you don't have knowledge, like how the government tells you, if you don't have knowledge, invest in mutual funds. Very simple. Mutual funds, they are you giving it to experts and then they invest in the market. Obviously, it involves some level of risk because going in market itself is there. Now, even in mutual funds, there are different growth mutual funds, mid cap, large cap, small cap. Again, I'm confused in mutual fund also which one to go. Debt, liquid, hedge funds, hundreds of other mutual fund types also. So then they say that why not go for exchange traded funds? Sir, what is exchange traded funds? Exchange traded funds, they track an index. Okay, example Nifty 50. So your Nifty 50 is there. As Nifty 50 will increase, your value will increase. Or they can invest in Nifty 100. Okay, so here, or they can track Sensex. So exchange traded fund does not track. You're not investing in a company. You are investing in a fund which tracks a indice. Like for BSC, the indice is for NSC we have Nifty, which is the indice, and this is called as a Sensex. So here, if I invest in exchange traded funds, it is going to track Nifty. You see, Nifty, BSC. So if Nifty will increase, your value will increase. That is it. So this is what, and this is very good because what happens, you're not investing in any individual company, you're investing in a bunch of top 50 companies, top 100 companies, average index. So I invest generally in exchange traded funds also, which are technically, if you go to invest here, investment portal, it is called as Nifty Bees. You can even invest in gold bees, it tracks gold. Okay, so in Nifty Bees you can track and check how the performance works, etc. So is a security that tracks an index, or as I told you, gold bees, commodities, bonds, etc., which is actually a basket of assets, like an index fund. Exchange traded funds are tracks indices such as Sensex and Nifty. When an investor buys a unit of this, they buy the performance of that index. If that index performs well, you earn money. If that performance doesn't perform well, you don't earn that money. Okay. Unlike regular mutual funds, exchange traded funds are common on stock exchange. The prices of the exchange traded funds are trading at market prices. Okay, so if the index goes up, it goes up. When the index goes down, it goes down. Very simple. Derivatives. What are derivatives? Okay, here we have do it from the sum section. Theory they don't ask. Okay, but I've covered both the theory and the sums in the sums folder. In that you will have futures also. Okay, and just remember one thing, that currency future, this is through an amendment they are just told, which is very simple, that even rupee can be traded in the IFSC, SEBI International Financial Service Center. Okay, sir, what is this? Again, pay attention that there is a chapter on this. Lesson number 7 is about International Financial Service Center full depth. So just remember that as we can buy dollar today and deal in derivative of dollar, means if dollar goes up I earn more, dollars go down I lose. So those things I can do. That can happen of rupee in the IFSC, where internationally all the traders will bet on rupee whether it will go up or down. Options also, sums are there. So in this chapter particularly, sums can come with respect to options, which is very common. All of it which we have covered in the sums folder. You can get it from the dream batch or our regular lecture. Now we come to a concept which ideally we would already know, which is your section 62 1A. Section 62 1A of right issue, which is called as right issue. Okay, what is right issue? So right issue basically is when the company issues to its existing securities, existing shareholders shares. We tell the existing shareholders, listen, we are giving you new shares at discount. You want, you can buy, or you want, you can not buy, or you want, you can sell your right to someone else. You can sell your right to someone else. Okay, that also you can do. This is called as right entitlement. Why we are giving this right? Because you are a loyal investor, you've already invested, we're going to give it to you. Okay, now this rights normally today, how does it work? In your demat account, automatically you will receive a rights in your demat account. It will be written that you can either apply for it, okay, how much you want, full or even partial. You can apply for additional. You can even renounce it. Renounce it means you can say I don't want it, or you can transfer it to someone else. So these are the options available to an eligible investor in his demat account. Common sense, if they give me and shares are offered to me at discount, I may choose to buy, I may choose to not buy, I may choose to transfer it to someone else. That is called as renunciation. Now renunciation, how it can be done? Sir, what do you mean by renunciation? Renunciation means I can try to sell it in the market or off market. Off market means I have a friend who is ready to buy. I go to the broker, I tell him that this person I'm selling my rights, I have a benefit of 300 rupees. I'm going to give this benefit to my friend. He will give me whatever it is between mutually understood between us. I give my rights to him. On market means what? In my app only I can see that if someone wants in the secondary market ready to buy, I'll tell my broker, he will see that he can create a facility to knock off my rights to someone else. So obviously right is a monetary benefit. So you will have to see that if you can, how you can encash that benefit. So if the shares are trading at 120 and I'm getting at 80 rupees, 40 rupee benefit I have. So that benefit, I can tell someone that I'm getting at 40 benefit, you just give me 20 rupees, you take the 40 benefit. Simple little point. Now we come to another next important thing that they can ask you in the exam. One is your trading platform. So there are various trading platforms or stock exchanges. Main board, that is your NSE, BSE, which is normally a general person with limited knowledge of security markets will only know about NSE, BSE, right? That is called as your main board. But there are subordinate boards also. Subordinate boards means are for smaller companies. SME board. BSE SME and NSE SME is called as emerge. So if you go to www.nseemerge.com, so BSE SME, that is a small and medium exchange platform where for companies which are smaller in size can get listed. Third stock exchange is called as a innovators growth platform. So innovative companies, those who have brought a technological breakthrough. The word is technological advancement. Fast growth companies are there, they can get listed on innovators growth platform. That innovators growth platform normally is for getting visibility to anchor investors, to if I'm a fast growing company, and imagine today in India there are a lot of venture capitalists who want to invest in early stage companies. So they will not look at NSE BSE because they know that they are mature companies. What they will grow 10%, 20%. They will not become 10 times in the next 5 years. I have to catch a early stage company. So that either smart investors and those sophisticated investors either look at NSE BSE, those companies which might transit it later in future to main board, or they will look at innovators growth platform. Innovators growth platform, those companies get visibility. They might not be able to tap public, but they will be able to sell it on private placement to HNIs or QIBs. Then comes people like me who have a very big heart, and you also who have a very big heart, want to do something for the society after they become big. So then they can get. So what used to happen earlier, NGOs used to go looking for raising capital to very traditional means, very difficult to raise capital. So now government has said that NGOs, let them get listed and raise funds. And here the NGO getting listed, raising money, and people whoever invest will get zero coupon, zero principal bond. That means if I invest in a company listed on social stock exchange, because they have a social intent, they have a social intent that they want to help the society, do donation, charity. So when I invest in such companies, I will get a instrument called as zero coupon. I'll get zero interest, zero principal back, like a charity. Clear? Which we will see in depth. Now from here, I want you to know, see, how to get listed, etc. All of this we have covered in that will get covered in ICDR regulations 2018. So here you can just go through quickly. There's a dedicated chapter on this, okay, in the part B. From here you can see this part, SME platform. On SME platform, if a company wants to get listed, okay, so it has to be a company first. Requirements for getting listed on SME platform. They shouldn't be a really big company, means they should not have a post issued capital of more than 25 crores, means max 25 crores. They need to have a positive net worth and a net tangible assets, means tangible, not intangible. Tangible assets of 1.5 crores, and they should have a track record of at least 3 years of profit. Imagine if it is a LLP or it is a sole proprietor and they were functioning, so they can also get converted into a company the previous time when they were in another structure, LLP, that will be counted. Okay, the company should have a website. Everything will be done in demat form issues, and there should not be any change in the promoters in the preceding 1 year from the date of filing the application. So 1 year prior, in the last 1 year, no changes in the promoters. Now when we come to NSE emerge, again similar thing. NSE emerge is a NSE SME where companies can get listed on NSE stock exchange. Okay, now let's read. This is the main criteria where it is covered. Now what are we doing? We're looking at first, post issued capital. This you need to learn. Okay, this you need to learn. There are thresholds given that if I'm getting listed on NSE, okay, NSE emerge, then I require 25 crores minimum, these 50 allottees, okay, underwriting 100% underwriting, application size should not be less than 1 lakh, financials have to be reported half yearly, and market making means if anyone wants to sell, broker has to buy, okay, market maker will buy. So a two-way quote will be done. So anytime it is becoming a liquid thing, it's not that I'm blocked. Then comes a main board. This is on BSc, NSC, BSc. Main board. At least 10 crores. Minimum allottees is 1000. Okay. Application size is 10,000 to 15,000, and reporting is done quarterly. Right. Then we come to Innovators Growth Platform. Now I want you to just note it down. Innovators Growth Platform. Now, Innovators Growth Platform, two important criteria are there. Two important criteria. That they should be a, technology intensive company. Means they should be mainly a tech company. Massive amount of technology where there is a potential of fast growth. And prior 25% should be held by QIBs. QIBs for past 2 years. QIBs, okay? So now pay attention. What is happening? Like a company is there, they must have pitched to an QIB, they have got funding. 2 years the QIBs are investors, and it is a technology intensive company. They can get listed on this Innovators Growth Platform. It is a dedicated platform where any QIB is there. They will come to know that if this company is listed, they have already raised money, they want to raise more money, they want growth capital. So I will invest. Now pay attention to this. Earlier, this IGP platform was called as ITP platform. Don't need to go into that. Just remember the name change. Institutional trading platform was there. It has got changed to IGP platform. Now, what is it? It's important that it means a trading platform, okay, where a company with intensive use of technology, okay, nanotechnology, biotechnology, okay, and 25% of the pre-issue capital is held by at least 2 years by a QIB or a family trust or a good investor or the following entities, any of these entities. So again, what is a IGP platform? That it is a technological intensive company, means it's a full tech company where at least 25% was held by QIBs for 2 years. So we know that these companies got funding already, and now they can get listed here for growth capital. Okay. An entity meeting all the following criteria. So basically, the investment fund under management should be $150 million. Minimum assets to get listed on this. It should be registered with a financial sector regulator. It is a resident of a country which has met the money laundering laws, and it is not identified that you are a company of a country which is deficient in complying with money laundering. Clear? Then we come to the next stock exchange, very, very important, called as social stock exchange. This was introduced by chapter 10A of the ICDR regulations 2018. Now this entire topic is covered in your ICDR regulations. Okay, so you can do it from there, but I will still tell you what it is. So NGOs wanted to take in funds, so how they will go? They used to go privately through word of mouth. So government says, why not list them also? Anyone who wants to invest in these funds, they can invest. So your NGOs, non-profit organizations, can get listed, and they can only get listed for visibility. They don't want to raise fund like a public issue. Second category is they want to get listed and raise funds also, means they want to make a public issue. That also they can do. In the first category, you just do for visibility, brand purpose. And third is a profit social enterprise. Maybe like example Tata's. So Tata is a profit oriented company, but they also have a social intent. Tata's also has a social intent that, listen, I do a lot of charity, I can also want to be identified as a social enterprise. So they will have to meet the criteria, and then they will be called as a social enterprise. The Tata has helped they give a percentage that this much percentage you should help, you should spend for the target audience or for growth, then you will be treated as a social enterprise. Social enterprise is a profit making company, profit oriented company, but which is working for the benefit of society as well. Okay, so eligibility to get listed on the social stock exchange. Okay, you should have a social intent, you should have an intention to help the society. Okay, the social should have any one of the activities. So social enterprise should have at least one of the activities that basically I want to. If you see, remember your chapter 7 of Companies Act, section 135, which is your CSR. Very similar to those points have been given. Eradicating hunger. What does the NGO would do? Okay, promotion of good health, protecting national heritage, environmental sustainability, gender equality, promoting education, rural sports, incubation of good enterprises, disaster management. Okay, promoting welfare of migrants. Okay, bridging the digital divide. So whichever is there between rural area, they want to make in better technology, they can do that. Second, the social enterprise shall target undeserved, less privileged segments. Obviously, you will target poor people, right? Unprivileged people who don't have much privilege, you will have to target them. Logical. And the social enterprise shall have at least 67% of its activities. Now just write this word 67%. Very, very important. That Tata's example, if you want to be qualified as a social enterprise, you're making profit. Fair. But 60% at least should have minimum 60% for your expenditure should be done for target audience, or revenue should come from eligible. This revenue, average revenue comes from providing eligible activities to the target population. So this revenue also is coming, maybe like being human, you're getting this revenue and then you will spend from providing activities. So basically I am giving activities to members of target population. So maybe I am selling to them at discount, but I am getting that revenue. So we are charging them at a subsidized rate. So that is also fine because you are helping selling to target audience. And third, expenditure 67% is being done, or members of target population to whom have been provided at least 67%. Eligible activities are being provided at least 60% as the customer base. So they are either you're selling to them, that your 67% of your target population are your customers. So similar points that is there. So I'm earning from them, target population, I'm spending on them, and my entire base is at least 67% is my target audience. So I try to help my target audience in whatever way it is possible. Okay, now we see this requirements relating to registration of NGO. So not-profit shall NGO shall mandatorily seek registration with stock exchange. Okay, the minimum requirements for registration will be provided by SEBI, and they will have to meet the eligibility criteria. Nothing great has been given. Now margins, remember that this will come in your derivatives. In derivatives there are two kinds of margins. One is when you take the position. Now this is covered in the sum, so I'm just going fast. When you take the position, you need to have initial margin, that is the initial money in your account. Maybe it could be X amount. They are saying that if you want to take this position, you want to take this contract, you want to enter into that, this much money you need to have. Now what happens if the market starts going against what you decided? Then you will start losing that money. That money will start depleting. Now it can go down till maintenance margin. Maintenance margin. This is the minimum account balance that you need to have. This is at the start. This is when your position start going against you and you've gone below the maintenance margin. Then you will get a margin call that you have to refill your entire account. That your money and the account has gone too low, you have to refill it. So these are the margin trading, they call it. So what happens is, as everyday basis, if the position is going good, I keep earning more. If the position is going less, I start losing more. Okay. So in the start, the amount that I have to keep in the account is called as initial margin. As the position starts, we start looking how the trading is going. The trading starts going bad, my money will keep depleting till one point, which is called as maintenance margin. If I go below that, the broker will call you that sorry, your minimum account balance is being hit. You have to put in more funds. That is it. Okay. So this is covered in the sums part. You have to do it from there. Then comes book closure and record date. Very, very simple, very, very easy. For this, I want you to write down few things. That is your section number. You will write down your section 91. You will write 45 days. You will write 30 days. You will write 7 days. That's it. Done. Your concept is done. Now pay attention. A book closure date and record date. Now, in order to decide to whom to give the corporate benefits. So let me tell that if I'm giving dividend or if I'm giving corporate benefits like dividend, right issue, bonus, so the shares are being traded continuously. Who do I give to? Imagine, one second I buy, one second I sell, one second I buy, one second I sell. So it's so difficult to figure out to whom to give the corporate benefits. So the company closes the books of accounts, books of register of members. So shareholders appearing on this day will be entitled to the corporate benefit. Understood? So whoever's name is appearing on the book closure date, so we close the book. On that day, whoever's name is mentioned, they will be entitled to the corporate benefit. So now first, the company can close the books of accounts maximum in a year for 45 days. And they can keep closing, that's fine, but maximum in a year is 45 days. At one given time, 30 days max. So in the entire year, collectively 45 days. At one shot 30 days, and before closing 7 days advertisement that I'm going to close the books. So if you want corporate benefits, don't sell your shares, right? So telling that when the book closure date is there. So company has to close their books, register of members to determine to whom to give the corporate benefits, etc. The record date is a date on which when the whoever names are appearing on that date, those shareholders will get the. So section 91, maximum in a year, not more than 30 days at one time, and before closing 7 days advance public notice will be given that when you're closing the book close. Now very, very, very important, repeatedly asked question is your block deal and your bulk deal. Very, very important. I can say 100 times they have asked this in the exam. Very, very important. Very simple. Now pay attention to this. Block deal is a separate window made by the stock exchange. So on the stock market, you will see a separate segment is there, a separate window is there called as block deal. In block deal, what happens? A single transaction of more than 10 crore rupees, so greater than 10 crore, one transaction is greater than 10 crores. What happens? A separate window is there to go and sell. It's like a 15-minute window. Now this 15-minute window, they've told also, one is in the morning it opens and in the afternoon it opens. So 15 minutes in the morning, 8:45 to 9 a.m. it opens. You can go and sell, and 5 to 2:20, 15 minutes again in the afternoon it is open, where block deals take place. It is taken through a single transaction. So maybe if I'm having, now imagine for like these big players, if I'm having 25 crores of shares, worth of shares, the value of the transaction 25 crores. I want to sell now, obviously such a big sale, even broker will get shocked. So I just go to the stock exchange, block deal, sell it within this time frame, done. My job is done. They've also said that during that time, the pricing should not be above, okay, must be between, you can say 1% price difference is allowed. Obviously, because some amount of price range fluctuation could be there, but not big. So from the previous day closing, so if the previous day the shares had closed at 100, 1% up and down is allowed. So I'll take what was the last yesterday. So yesterday it was 100 pricing of the share. So today when I'm doing the block deal, it will be between the 1% range only. That is called as block deal. So a separate range for doing 1 crore transactions. 15-minute window is made, one in the morning, one in the afternoon, whenever you want you can go and do. Now bulk deal. Bulk deal is basically when all buying and selling transactions of more than 0.5 of the total shares of the listed company happens in a day. So imagine of one listed company, if 0.5% of total shares, okay, are traded, so that is called as a bulk deal. Okay, 0.5, 1% shares of the listed company, for example, as being bought or sold. So that is called as a bulk deal. What is happening? Imagine if I add 1% of the listed company shares. I went and I sold in the regular market. So there's not a separate window, no separate window here. In the normal window, I just make a note, I just sell it. Broker will take a note that, listen, this guy had 1% more, 0.5% of the total shares or more. He sold it in the regular market. So he'll just make a note and he'll inform stock exchange. So it can happen anytime during the trading market hours from 9:15 a.m. to 3:30 p.m. It happens during multiple tranches on the same. It can happen. I can sell it in parts on the same day, and it can happen at any time, any price prevailing in the market. Very simple. So if I am holding 1% shares or 2% shares, I will use the block deal. I will sell it maybe in one go or in parts of the same day. If I do that in the same day, if there is a buying or selling of more than 0.5% of the total shares of a listed company, the broker will make a report and send it to SEBI. That is all that is there. Very simple. We'll do a recap. Block deal. Sir, what is a block deal? It's for a really big investors, like really big investors who have 10 crores of transaction, minimum order sizes of 10 crores. They have 2 slots. Order price shall be within this much range, and then they can knock off. Okay, stock exchange will disseminate the details that this guy has sold so much, and is not open for individual investors. They are primarily for institutional investors. Common sense, 10 crores. Obviously, institutional investors will be holding that kind of shares. Bulk deal is total quantity bought and sold, okay, of a listed company of 0.5. Can be done anytime during the day. Okay, the broker will reveal to the stock exchange about the bulk deals that has happened on daily basis. Now we come to the next thing, is stock market index. Very simple, very easy. Okay, so for this, in the module maybe you might find it a little difficult, so pay attention to what I'm telling you. It's a very simple concept. That what concept we are doing? We are doing the concept of index. Now Nifty, when I tell you Nifty and Sensex, I'm going to teach you something very important, so pay attention. Nifty comes from the word 50. It's a average of the top 50 stocks. Sensex is an average of the top 30 stocks. This is normally what you understand. This is an index. Okay, Nifty is an index for NSE, and Sensex is an index for BSE. Today we will see the exact calculation of how Nifty is calculated and Sensex is calculated. Okay, so first, the concept of index, it was first published in 1986. Okay, based on market weighted stock exchange of the top 30 companies. Okay, it is done by a free float method. Very technical terms they have given. Concept is extremely simple. Okay, so free float means what? It takes into account the proportion of shares that are readily traded in the market. Okay, it does not include shares of the promoters or lock-in shares which are not available to be traded in the market. Okay, so now I'll explain the concept. Will get over in 2 minutes. Very simple. Now, how is the index actually calculated? So first we'll see for Sensex. So here there is a base year. The base year index value is taken and the base year market capitalization was taken. So the base year was kept as 100 points. Base year means we always calculate the index on basis of a base year. That base year index points was 100, and that year when the base year was there, the market capitalization means all the top companies base was market capitalization was 11,473, right? This is a standard. This is given that 100 was the base year points and market capitalization that time was in the base year was 11,473. Now we will take today's current year's total free float market cap. We have to take today's market capitalization. We will take today's market capitalization. But free float, sir, what does free float means? Free float means which are free to be traded in the market. So it excludes promoters and any lock-in shares which cannot be traded, or maybe something on which there is a lien on shares, etc. So which cannot be traded will not be taken. So the market value of the shares today which can be readily traded. So let's say if this is the market value, then according to this you will get the Sensex in the Sensex. So this you have to put today's market cap. Today's market cap has to be done, and so accordingly you will get the Sensex. This is fixed. These two are fixed. Right? Concept clear? Yes or no? So how do you calculate? You will need what all data? You will need the base year. The base year is 100. Okay, I've given you the base year market cap also. And then you have to just put the current year's market capitalization. Automatically the index will be made. Simple. Now similar for Nifty also. Nifty is of the top 50 stocks. Okay, of it is calculated same concept. Only the base year and the market cap of Nifty will be put up. Okay, base year is 1000. Base value is kept as 1000. Then we comes basics of investing and guide for investors. This is not supposed to come in the exam. It is just that today if you want to invest in the market, what I need to do, I have to ensure that I have various risks. I have to be aware of that risk. Market risk that it can go up and down. Systematic risk. Systematic risk means it you may get a overall fall in the market and you cannot do anything. Recession, war, COVID. There is a systematic risk. The entire system will fall. Unsystematic is only when that related to that company. For example, there is a fraud in one company. So unsystematic is related not with the full system. It is related only due to that company. There was a fire in that company. Unsystematic. Inflation, cost of raw materials went high. Liquidity risk. Okay, that risk that investment cannot be sold quickly. Business risk, the business failed or the business model is no longer useful. Volatility risk, there is always a volatility, stock prices fluctuate on a constant basis. Currency risk, okay, that foreign exchange fluctuation makes the rupee value weaker. Okay, so this is there. Then trading, what are so one is understanding the different risks that you are subjected to. Second, you need a bank account to put in funds. Then that from there you can have your demat account. Demat account you can open with your broker. Now, whenever you make a purchase or sale, you will see that a clearing corporation is involved. Sir, what is a clearing corporation? Their job is to clear the trades, settle the trades. Now imagine you are the seller, okay, of shares. This is the shares. There is a seller and there is a buyer. If you've ever seen in stock market, we don't know who is selling. When I sell, I don't know who's on the opposite side. I don't know whether he will be able to pay me, he will default, who will do. So the entire process is handled by the clearing, the T plus 2 days, T plus 0 days, that debiting from that account, crediting the shares. The entire process is covered by a clearing corporation. So they ensure that the counterparty risk is not involved. So they mitigate the counterparty risk. I don't care if I sell the shares. I don't care if the other guy, who is he, will he pay me? I don't know. It's all handled by clearing corporation. So this instills confidence that the trades will be executed, provides counterparty risk guarantee, okay, and ensure that we have a proper risk tight system, that we don't have any risk in the market. So they ensure, what do? They ensure periodical settlements, proper delivery of securities, proper payments are made, okay, all of this is ensured. Then comes market surveillance. Market surveillance means what? You have to understand that SEBI is responsible. SEBI is responsible to survey the market. Now, when I say market surveillance means what? I'll call it as monitoring. It is called as monitoring. So they monitor, is done on a continuous basis. Monitoring is done in two categories. Okay, one is called as price monitoring, and this is called as volume monitoring. So unusual fluctuations, unusual fluctuations are monitored, kept under surveillance. Automatic reports are made if there's an unusual price movement or unusual volume quantity of purchase done. SEBI keeps monitoring it. Now they also do something called as preventive measures and detective measures. In preventive, they have margin trading. So we come to know that if he doesn't have funds, automatically the maintenance margin is hit, automatically the trading will be blocked if he doesn't refill. Then preventive measure could be rumor verifications, etc. Detective could be basically identifying the fraud after it has occurred. So let's see. You have to just learn the headings, that is enough. Circuit filters, preventive measures, so strict norms. Before onboarding anyone, SEBI will have a lot of laws to be followed. That is called as onboarding norms. Circuit filters means if the circuit is hit, if a stock goes above X percentage, trading in that stock should stop because it goes unusual. Okay. Cancel on logout. So moment you log out, it will go away. Kill switch is basically, again, automatically the member can, to prevent over trading, they ensure that if I lose money, I try to keep trading. So I will already say that if I trade above this, it should kill the switch, means I'll be logged out. So all these headings you can do, it is more than enough. Rumor verification, etc. Post trade surveillance also can be done. Okay, we try to look at patterns, etc. Now, risk management in secondary market. Let's look at risk management. Isn't given much. So directly we come to your impact of policies. Now, one is Fed. Now, what is Fed? Do you know? Federal Reserve. Like how we have RBI and RBI policies there. Here we have the Fed, okay, which is of USA economy. Now, if we are studying Indian laws, why they have to teach us the US central bank's policy? is called as Federal Reserve Policy. Why are we concerned? Because USA is such a big player that it is said that if USA sneezes or USA catches cold, the world will sneeze. Means if anything happens to USA, it has a effect on everyone else. So therefore, understanding that what Federal Reserve is doing, they do the same functions as RBI, right? So you can write they ensure that price of stability of financial market. Just think about it. RBI does promote consumer protection, ensure they make the monetary policy of India, etc. This they will do of USA. Now the question is, how does the change in Fed rate impact India? Multiple times, if you are ever trading, they always go to see that what the Federal Reserve is doing, what the USA central bank is doing. So let's take an example that if the Fed rate, okay, the rates are increased by USA. If Fed has increased the interest rate, what will happen to the rupee? What will happen to the Indian economy? Good or bad? So if the rates are increased by USA, the Indian economy crashes. Sir, why like that? Because understand, if they have increased the interest rates, people will start, global investors will pull out money from India and invest there because FD rates have increased in USA. So USA is considered to be a bigger, safer, more stable economy. So the world will invest in USA. Okay, the global investor, they have increased their interest rates. So now we become less lucrative because that competitor, our competitors, countries also have competitors. Our competitor is USA. They have given better interest rates. So global investors will go there. So under pressure, the RBI government will have to increase the rate in India also. Okay, or we will at least ensure we don't reduce. So this is that you have to remember. Okay, that the interest rates are there by the common reserves. If Fed increases the interest rate, okay, the Indian hike in may not impact the countries outside India. Now this is like an insult. They are saying that everything that USA does will impact us, but what we do doesn't impact outside India. Let's see. So here we come. So rupee and dollar. If Fed rate is high, the dollar would go up, weakening the rupee. So this is what I told you. That if Fed rates are hiked, obviously people will invest there. The value of dollar will go. Country looks more lucrative. They are giving more interest rates. It weakens us. Bond market pressure. The logic is clear. There's no rocket science to it. Okay. So due to higher Fed rate, the bond rates would go up. Okay, and will put pressure on Indian bond rates because people will say that they are giving more. We'll go there only. So with higher federal, it weakens the rupee and vice versa. Okay. Then comes to our credit policy. So RBI is the Central Bank of India, which makes the monetary policy of India. They ensure that there is rapid growth, proper stability, price stability, that we have more exports as compared to imports, which is called as positive or surplus balance of payments, more exports than import. Now, these rates sometimes you should know, it's very, very simple. Repo rate is there, and reverse repo rate. Very simple, and the concept also you need to know. What is repo rate? Normally, RBI and bank, okay, it's between RBI and bank, commercial bank. So normally, commercial bank will borrow from RBI. So commercial bank borrows from RBI. That is called as repo rate. So when the commercial bank needs money, they will go to RBI that please give me loan. They get a loan. Okay. Till here it is clear. Reverse, when it would happen reverse, that is called as reverse repo rate, where RBI borrows from commercial bank. That's illogical. It doesn't make sense. RBI is borrowing from commercial bank. That's why it's called as something ulta is happening, opposite is happening. Reverse repo rate. Now, why RBI does that? Because they want to drag the funds from the commercial banks. They don't want too much money supply. So the entire repo rate and reverse repo rate is used to control the monetary supply or money supply in India. So if RBI wants to, withdraw funds from the economy, they want to suck out the funds from the economy. They want to, extract funds. They don't want. There is too much inflation in the market. So let's pull some money. So then they will increase the reverse repo rate, so that banks would want to deposit with RBI, and RBI will be able to nicely borrow it from the banks. Now let's look at the impact of repo rate and reverse repo rate. Pay attention. Okay? Reverse repo rate, repo rate first. If repo rate is increased, what will happen? What will happen to inflation? So I'm just thinking, okay. So repo rate is where commercial banks borrow from RBI. Now, since the repo rate has been increased, commercial banks will not borrow. Okay, they will not borrow because the loan amount is very high, and obviously commercial bank will not borrow, and obviously the people will also not borrow. So money supply will reduce in the market. So it reduces inflation in the market. So this is the main category. So you look at increase in repo rate will decrease the inflation in the market, because as we increase the rate, commercial banks will find it more expensive. Citizens will find it more expensive. They will not take the loan. If I look at reverse repo rate, what is happening is RBI borrows. If that is increased, if reverse repo rate is increased, RBI is ready to borrow at higher rates. So they need money. Commercial banks will happily give. Commercial banks will give more money. Okay. That even the investors will, since they get more money, they will also demand more money. The banks will demand more money. They will tell that we are giving high FD rate. So they will give the money here because they are getting more money. They will give the more rates because they will also give further more money. So what happens again? Inflation goes. Okay, logically, what is happening here is RBI is ready to borrow at high rates. So RBI is giving good interest rate. So as a bank, I will prefer to give more loan because I'm going to get high interest rates, right? So it's good for me. So I need more and more funds. So I will give more interest rates to the people so that they deposit with me, so I can give more loan to RBI. So that way I'm trying to withdraw the funds from the market. So this way it is used. Now, next, if we go to see cash reserve, banks are told to keep cash with them, at least cash reserve ratio. So this is hard cash that needs to be deposited with RBI. So banks, commercial banks will have to mandatorily deposit cash with RBI. So if RBI increases the cash rate, they tell that more has to be given. You are withdrawing the funds from the market. Similarly, for statutory liquidity ratio, your cash and cash equivalents. So cash can also be given. So maybe if the cash reserve ratio is 5%, 5 cash has to be given, and statutory liquidity ratio is 25%. So then I have to deposit not only cash equivalents, government securities, whatever the bank has, they will give. Okay, that is it. Then comes inflation. This entire tool was done to control the inflation in the market. Now inflation, okay, Inflation index is an economic tool to measure the rate of inflation in the economy. So in our country, if we want to know that inflation, how big or less it is, so there is a certain matrix that they are called as consumer price index and wholesale price index are two major indices for measuring inflation in India. Now let's look at an example of what is consumer price index and wholesale price index. A consumer will buy goods directly. So what is the rate given to consumers? Retailers at what rate they are giving? And consumers generally buy products which impact them. They don't go and buy industrial products. They will buy day-to-day fruit, they will buy petrol, etc. So we look at consumer goods that are, what is the rise in the consumer good prices? Wholesale price index would be on a wholesale basis. How much prices have increased? Now let's look and complete it. Now this you can take a screenshot. Very simple. Here we look at wholesale level prices. Here we look at retail level prices. Obviously, consumers look at retail prices. Wholesale level, we are looking at the wholesale level prices. Now, what you need to remember that which government department is issuing this. So here the National Statistical Office is issuing. Here the Office of Economic Advisory is issuing. In commodities, we look at goods only. Okay, in wholesale price index, we look at goods only. And here we look at goods and services. Inflation measurement, this is at the wholesale prices at the first stage. This is at the final stage. This is by price paid by wholesalers. This is the price sold paid by consumers. Now, which types of commodities are covered is given here. Base year. So, in order to understand inflation, I have to look at a base year and then I will look how much is the price today. So, two prices are needed. So, 2011-12 and this is 12 is taken as the base year. Can be revised. Okay, so wholesale and price, this is also they've asked in the exam. Let's see. So it is computed by this office. Okay, this was the base year 2004-5. Base year for this is currently 2012. How many items are involved? In wholesale price, we look at 676 items. Okay, consumer price index, it is made by the Ministry of Labor and Employment. Base year is 2012 and the basket has 448 goods for in rural and 460 in urban. So this also screenshot you can take. This we had seen 2012. Here the items covered 697 and here 448 and 460. So something that you have to learn. This is only goods. This is goods and services. This is this Ministry of Commerce and this is Ministry of Statistics. Okay. With this, we have completed the entire chapter, including all the past exam questions. Thank you. Hi. So we start with your SCRA Act 1950s. Now, when the stock exchange had started, it had actually started in the form of a banyan tree. Under the banyan tree, the brokers used to stand and they used to issue the shares. People used to come under the share, under the tree, purchase, etc. Now, this entire concept of this was found by one broker, which was called as the Premchand Roy Chand. Okay, so it's an Indian stock exchange which is located in Dalal Street. It was established in 1875, founded by Premchand Roy Chand. Now, the founder of BSE. When he started out as a for a brokers association. So it was all the brokers that were there. Then there were multiple stock exchanges that were formed, not only in Bombay, Calcutta, Madras, etc. But now we have only two major stock exchanges. All the regional stock exchanges have been shut down. Okay. So we know that we have the two main stock exchanges, that is BSE and NSE. That is 1875 and 1992. NSE was founded in 1992. Now the thing is, why are we studying about stock exchanges when we are going to do the chapter called as SCRA Act? Okay, so I spoke about stock exchanges when it was formed, the major stock exchanges. Now why about stock exchange? Because the object of SCRA Act, and this is from where we start with the chapter, the object of SCRA Act was to regulate working of stock exchanges in India. The main act of SCRA Act 1956 and the rules are in 1957 was formed so that the working of the stock, how stock exchange will be granted recognition, when it will be withdrawn the recognition. Third is for the running of the stock exchange, how many intermediaries will be there, all those things, and ensuring that wrong, undesirable transactions are not entered, so they are proper clearing corporation to ensure that the proper trades are settled, etc. Now, when we start with your section 1 tells you the name of the act, 2 gives you the definition, from 3 onwards we will be starting. But how the chapter is placed, pay attention. We are going to study this chapter in 2 parts. The first part is understanding the SCRA Act. Okay, and through that I will continuously be telling you which all exam questions will come. And second is the SCRR rules. So which important rules are also there, I will tell you. So first we start with the act. The act, you can study it in 2 parts. Once that part A, which talks about the stock exchange, everything related to stock exchange, and second, if you don't follow, what all penalties you get. Now let's start with your section. So section number 3, section 3 talks about application for a recognized stock exchange. Today, if anybody wants to set up a stock exchange, or when we have BSE, NSE, when they were set up under section 3. An application has to be given to whom? To the central government. So section 3 subsection 1 says that a application, okay, every stock exchange desirous of being recognized has to give an application to central government. CG has given that powers to SEBI today. Okay, the powers of central government are exercised by SEBI. The application will contain not only the details of the stock exchange, what they plan to do, how they want to do, and the bylaws. In exam, they had asked a question that explain the procedure for making an application to recognize stock exchange. Section 3 you have to quote, and in the end we will also be seeing some bylaws and the rules also. So section 3 says anyone whose desirous will give an application to get a stock exchange recognized. It will be given to central government. The working is done by SEBI. If central government is satisfied, they will grant the recognition to the stock exchange. That everything is in place, they will grant the recognition. Now when they are granting recognition, they will tell the stock exchange that listen, you have to make it in the form of a corporate and it has to be demutualized. What 2 words they have used? That the stock exchanges, every single stock exchange, okay, has to be made in the form of a corporate and it has to be demutualized. First is, sir, what do you mean by corporatization of the stock exchange? If you go to see the NSE, what is the full form of NSE? Please tell me. It's not National Stock Exchange, it is National Stock Exchange Limited. What is full form of BSE? It is Bombay Stock Exchange Limited. Means both of them are corporates, they are companies. And they are demutualized. Demutualized means the earlier stock exchanges were a mutually owned by brokers. Earlier stock exchange which was there, it was made in the form of an NGO and it was made as if it was owned by Prem Chand, Roy Chand and all the other brokers. So they said now it will be, not mutually owned by brokers. Demutualization means they will be owned by public shareholders, public directors, etc. Concept clear? Yes. So the procedure on how a stock exchange should turn into a corporate and demutualization will be done. That is from broker owned to power, how they will give it to the shareholders will be told by government, by SEBI. Okay. Now just a few, it's not given, but I am telling you a little that demutualization, how it was done. So demutualization means conversion from a non-profit organization to a profit-making company. Both NSE, BSE are profit-oriented. They earn money, etc. It's a legal structure to a business structure. Now the committee for demutualization was Justice Kania. He was made to tell that how demutualization will be done. So important features of demutualization means majority will be broker, majority will be public shareholders and public directors. The board of stock exchange shall consist of, means the entire board of directors shall consist of 75% of public directors and 51% of the shareholding will be given to the public. So earlier the stock exchange was wholly by the brokers. So how they had to either sell their shares, they had to make fresh issue of shares to public to reduce the brokers shareholding and give majority shareholding. So 51% is held by public and 75% of the directors are public directors. Then comes section number 6. Now section 6 says the power of the central government to call for periodical returns. So obviously every recognized stock exchange shall furnish to SEBI the periodical returns of its affairs. Very simple. That how the stock exchange is being worked will be given to the SEBI about their affairs, the day-to-day affairs, any kind of major things as SEBI will prescribe. The returns are preserved for a period of 5 years. So every recognized stock exchange shall maintain and preserve the year for a period not exceeding 5 years as may be told by this. So maximum 5 years can be told by the government, central government, to preserve the records. Then comes annual report. Common sense, every recognized stock exchange shall furnish to the central government a copy of the annual report. Annually what functioning has been done. Okay, then we see the power of the central government. They have a power to make rules. So where after consultation with the stock exchange, the central government is of the opinion that they need to make certain rules, they can make or amend the rules also. Now important, I'll tell you what is important from exam point of view also. Clearing corporation. Now let's understand what is a clearing corporation. Today when you go and buy a share, buy, sell, you don't know who the other side is. The entire counterparty risk handling or counterparty guarantee is given by clearing corporation or clearing house. They ensure settlement of trades. So in settlement of trade, the seller should get money and the buyer should get shares. So this transaction is completed by a clearing corporation. So clearing corporation is an organization associated with the stock exchange which ensures that the transaction is confirmed, settled, delivered and get completed. Now role of clearing corporation, they will settle the trades, they will ensure that the confidence is there, they will ensure that the settlement cycle, that the transaction is completed within the settlement cycle. Counterparty guarantee, and they ensure that it operates in a proper risk managed environment. Then we come to a simple little point that the section 9, that the power to make bylaws. A recognized stock exchange with the approval of SEBI may make bylaws for regulation of its contracts. So how their contracts will be made with respect to the trading hours, how the settlement will be done, etc. Just how the forwards, futures, all those transactions will be done, all those contracts will be made. Now section 10 talks about power of SEBI to amend the bylaws on request of the governing body. They can even allow the amending of bylaws. Now section 12, power to suspend the business. So they, even if they feel in the interest of public, they can, after giving an opportunity of being heard, suspend the working of a stock exchange. Additional trading floor. Now just the question that a recognized stock exchange may establish a additional trading floor with the prior approval of SEBI. Additional trading floor means a trading facility additionally which is done for the investors. Like we see block deals are there, so a separate trading window can be made where they can be traded. So this can recognized stock exchange may do that after consultation and approval of SEBI. Conditions of listing. Okay, so all the details of when a company is getting listed on the stock exchange, they have to comply with the SEBI LODR regulations 2015. Now delisting. Okay, now when we see delisting, there are two kinds of delisting. For we have a chapter also. Delisting means a company's shares which are listed are being removed. Could be two cases: voluntary delisting and compulsory delisting. Voluntary delisting. Okay, voluntary delisting could be if the company wants to delist itself, they'll pass a special resolution and say that we don't want to be listed anymore. And compulsory delisting is basically if you got an order from SEBI to delist, okay, then they will have to give you an opportunity being heard and then they will delist you. If they have delisted you and you are unhappy with the order of delisting, you can file an appeal before SAT within 15 days of such decision. Okay, if SAT is satisfied, they may allow the appeal. Now see this, the exam question was there. What are the provisions related to delisting under section 21A? Now again, very simple, that the right to appeal against refusal to list the security. Where any stock exchange has denied to any company that we will not list your securities, then you can appeal to central government that listen, this stock exchange is not listing my shares. There's another provision also, same line, that you can even appeal to SAT under section 22A, that if you are being refused that your securities will be listed, you can go and appeal to SAT in section 22A, and you can even go to central government in section 22 within 15 days of the refusal. Okay, in both cases within 15 days of refusal. So section 22 talks that if your shares have been refused to be listed, you will go and appeal to central government. Here you will go and appeal to SAT. Now appeal time frame, always remember that if you're unhappy with the decision of SEBI, you can go to SAT within 45 days of order of SEBI. If you're unhappy with the decision of SAT, you will go to Supreme Court within 60 days of order of SAT. Okay, 45, 60, you can remember. Now very, very important, they have asked in the past exam question also, modes of recovery. See, what is modes of recovery? I'll tell you. If, let's say, there is a person who's failed to comply with directions of SEBI, did not pay the penalty, did not comply with the disgorgement order that return the wrongfully earned money, or did not pay the filing fees to SEBI, then we have a recovery officer. That recovery officer will make a certificate that so much recovery is to be done and recover the money. Understood? So if anyone is not paying the fees, or any person in the market is not defaulted in any money, then SEBI can recover. We have a recovery officer, he'll make a recovery certificate, this much have to recover. He can recover from any of the following modes. So how he can recover? Very simple. Just like how income tax authorities recover income tax, same powers are being given to this recovery officer. They can sell your property, movable property. They can freeze your bank accounts. They can take your movable, immovable. They can even arrest you, and they can appoint a receiver, a liquidator. So all these powers, and they can recover your entire money. Okay. Then powers of SEBI do not apply to IFSC. Okay, powers of SEBI does not apply to the IFSC. So International Financial Service Center is a separate chapter that you have. In that, it's very clearly told that there is a separate authority called as the International Financial Service Center Authority, who will be regulating that zone. So no SEBI, no RBI, no any other institution apply. So this is what they are saying, that the powers of SEBI shall not extend to IFSC. Finish. Very simple, saying that SEBI does not have powers under this zone, IFSC, because there is a separate regulator only. And this you will come to know in a separate chapter. Then a question that section 22D, okay, saying that the provisions of Limitation Act 1963 shall apply to appeals made under that as well. So exam question was asked whether the provision on limitation period applies to appeal. Answer is yes. Limitation period, whatever limitation periods have certain time limits. That time limits apply even under the SCRA Act. Then the part B is about penalties. Various penalties are being given. Okay, now from here, obviously it is impossible for anyone to learn all the penalties, but at least the important ones you can learn. So mostly you can write that the penal provisions say that if anyone has contravened any of the SEBI laws, then section 23, mainly they cover 25 crores penalty or 10 years imprisonment or both. So this is the more common provision that you see. Okay. Here, see. This is the main 10 years, 25 crores or both. Mostly they give this only penalty. 10 years, 25 crores or both. So 23 mostly covers this kind of penal provisions only. Okay. So you can remember the one that I have told you. Now coming to the power of central government under the SCRA Act. We've done all of this we've done, only headings here you can do. What is the power of central government? They can call for records, they can direct to make rules, they can suspend the business, they can suspend the directors, they can prohibit certain contracts, they can grant immunity, they can delegate certain powers. They've delegated to SEBI, they can even delegate it to RBI. Some of the powers you can read out. With this, we've completed the SCRA Act. Now the rules are also important, and instead the rules, that is specially rule 19A, they have asked in the exam also. So we will see the rules as well. So SCRA Act has to be read with the SCRA rules also. So first, okay, the rules is rule related to rule number 19. Application for list. Now we had read section number 3. What was section number 3 of the Act? That anyone wants, they can apply. And then section number 4 says the central government will grant you the recognition for a stock exchange. They are saying further what documents are needed. That is given in rule number 19. A public company desirous of getting listed. Now this they are talking about, if a public company wants to get listed on a recognized stock exchange, they have to give the following document. So a company which wants to get listed on the stock exchange has to give the MOA, AOA, okay, details of the promoters, balance sheets, auditor certificate, etc. That's all. Then 19A I told you is very, very important. Okay, so you can mark it as important. Rule 19A, which is very simple. You have to just remember 25%. That is called as a minimum public shareholding. Now, if you are raising money from public, obviously the public should be there, right? You cannot have 100% promoters shareholding. At least some amount of portion has to be given to the public. So every listed company should maintain at least 25% shares public shareholding. So there are only two, promoter holding and public shareholding. So promoters can hold maximum how much? 75%. Why? Because public should have at least 25%. So if public is taking 25, rest promoters can buy. 75% max can be promoter holding. Now they have said that this is when the act has commenced. Now this is irrelevant today. Moment the act was commenced, and that time anyone was below 25%, they were given time of 3 years to increase the minimum public shareholding to public to 25%. This is when the act was passed, 2018 amendment. The main one is here. If today any company, in any public company, listed company, the public shareholding falls below 25%, then what to do? It's important. So very simple. You have to restore it, and you have 12 months. So within 12 months, you have to restore 25% minimum public shareholding limit. Okay, very simple. So promoters will sell their stake to the public. So in any listed company, minimum 25% will be mandatorily held by the public. Now some relaxation can be given for public sector undertakings. They can be given some relaxation, and SEBI will notify that. Now coming to delisting of securities, we'd already done the section. Just a little bit of rules also. The rules, you can write the rule where that delisting of security was given. So here, when can SEBI order mandatory delisting of a company? So a recognized stock exchange may delist in accordance with SEBI regulations when they having losses for 3 years and with negative net worth, suspension of trading, infrequently traded, the promoters have been convicted, false address was given, public shareholding falls below the minimum public shareholding, and you were not able to restore within the said time. Opportunity being heard will be given, and then it will be delisted. So very important, rule number 21 to be done. Then comes the role of company secretary. Very important. A past exam question was also that what role we have in SEBI SAT. So we can represent our clients before SEBI and SAT. So we have a right of legal representation. Any person may appear in person, or he can hire a CA, CS, CMA lawyer to represent him before all these. So company secretaries have a right of legal representation, that is represent their clients in your SAT. With this, we've completed the entire SCRA Act as well as the SCRA rules, including the past exam. Hi, so we'll be starting with your lesson called as the Security Exchange Board of India. Now this chapter is very predictable, very small, and we can identify exactly what comes in the examination. There are some topics which are going to be relayed in other chapters, so I've contained this chapter only to what you need to know from exam point of view. So first we start with SEBI. Now SEBI was an organization or an authority made under the SEBI Act. So Securities Exchange Board of India is a regulator of securities market. It was passed under the SEBI Act 1990. So sir, what was there before that? So before that we had the controllers Okay, we are the controller of capital markets. Capital, okay, prior to SEBI, and they were passed under the Controllers Issues Control Act. Okay, 19. So very simple. So today we know SEBI, but prior to SEBI, we had controller of capital markets. SEBI was passed under SEBI Act, and this was controller was passed under 1947 Act. Now, the office of SEBI. Now, the SEBI head office is in Mumbai, okay, and they also have offices in Ahmedabad, Jaipur, Kolkata, Gwalior, Delhi, Chennai, Bengaluru, and Bhubaneswar. Now, let's understand what is the powers and functions of SEBI. Now, SEBI has the object of the act. The object of SEBI Act, or the main functions of SEBI, is three things: is to protect the interest of investors, develop the security markets, and regulate the securities market. So, if I say what is the main function of SEBI, is to protect investors and regulate, not only regulate but also develop securities. Okay, SEBI's simple: protect the investors, and this is given as per section number 11. We can definitely quote it in the examination. Second, what are the other functions of SEBI? So SEBI has multiple intermediaries. Okay, so their job is not only to regulate the functions of stock exchange, but also to register all the different intermediaries, like your brokers, underwriters, registrar to issue, merchant bankers, portfolio managers. All these intermediaries, we have a separate chapter on it. Prohibiting fraudulent trade practices, ensure promoting investor education, prohibiting insider trading, okay, and ensuring that there is a smooth takeover of companies as well. Now, to regulate and prohibit, okay, issue of prospectus. So SEBI has some powers in public interest. If you go to see in public interest, SEBI may prohibit, for the protection of investors, any company from issuing any document to solicit money from public. SEBI has a power that, listen, this company, the director has been prosecuted, so they can prohibit any company to not allowed to be gone to public. Simple. Now, SEBI can issue directions under section 11B. What directions they can issue? Very simple. Okay, SEBI can issue some directions. Now, what are the directions? That do this, you're not doing this properly. So they will give some directions, advice, some things to follow in the interest of investors, and to prevent any detrimental activities to the industry, and to ensure proper management. So SEBI can tell, after it has conducted proper inquiries, that they can give some directions, some kind of guidance. If those directions are not complied, SEBI can do a investigation. Now you see, where SEBI has reasonable grounds to believe that any transaction is being done in a manner which is detrimental to the interest of public, it may direct that person. It may by an order direct any person, officer, to investigate into the affairs of that company or intermediary. The most important and common answer that they permanently forever ask from this chapter is provisions about SAT. So if in this chapter anyone is saying what is important, it's very general, because obviously SEBI is something that we are only studying in this entire syllabus. You feel that the chapter is small, but actually it's a full syllabus. So we will be able to build. But what you need to know from this chapter is SAT. So this is a most repeated exam question. Most repeated exam, that what is the appeal provisions and what is SAT. So first, section 15K, okay, section 15 talks about SAT, that the central government will set up appellate bodies called as SAT, and these appellate bodies given under chapter 6B state that appeals from SEBI will lie to SAT. Now what are the powers of SAT? Same powers that a civil court would have. So same powers as a civil court. So SEBI will have, SAT will have all the powers such as summoning a witness, examining on oath, taking affidavits, okay, passing ex parte orders, dismissing applications, examining witnesses, affidavits, ask for summoning any document, summoning any person, okay, or any other power. So same powers as that of a civil court. Then if a person is unhappy with the decision of SAT also, they will go in appeal to Supreme Court. So appeal to Supreme Court is given under section 15Z, that if a person is aggrieved by the order of SAT within 60 days from communication, he can go, and all the appellate authorities have a power to condone delay, pardon the delay if there is a sufficient cause. The timeline is important to know, that if you are unhappy with the decision of SEBI, you can go to SAT within 45 days. If you are unhappy with the decision of SAT, you can go and appeal to Supreme Court within the next 60 days. With this, we have completed the entire chapter called as SEBI. And the main and most important thing from here to know is what is SEBI, what are the duties of SEBI, SEBI has powers of direction, and about SAT and its appellate provision. With this, we complete the entire chapter. Thank you. Hi, so we'll be starting with a chapter called as Depository. Now, Depository, to understand, you need to understand this diagram. First, today, if you want to invest in securities, now it is mandatory that you need to have a demat account. Okay, all listed companies mandatorily have to trade in demat shares. So an investor wants to buy shares of a listed company. For example, you want to buy shares of Tata's. So you cannot directly go and buy shares of Tata's online. You need to have a demat account. Okay. So in India, there is an organization that holds securities in demat form, in dematerialization form. That depository, that organization is called as Depository. There are two depositories in India, NSDL and CDSL. Now when an investor is here, he does not directly interact with NSDL, CDSL. There are a lot of intermediaries, okay, intermediaries. Like your own broker can become an intermediary, etc., where they are called as depository participants. So what happens? The investor opens an account with the DP. The DP is further registered with the depository, and then the depository connects with the listed company. So if I make this diagram for you, it will be very simple for you to understand. So investors today open an account with DP, depository participant. Sir, what is it? DP? DP is an interlink interface. It is an interlink interface, okay, or intermediary between the company, okay, between the, first you have a depository, okay, and then the depository will then connect with the company, okay. So this is how the investment process works. We open a demat account. With that demat account, I can start trading, and all these shares, organization that holds the shares electronically is called as depository. In India, we have two depositories, NSDL and CDSL. Very simple. This is the process how it gets connected. Done. So Demat account is opened with whom? With your DP, depository participant. Could be Zerodha, could be so many other ICICI Securities, etc. You have Grow. They are among the top brokers in India. You can open their Demat account also with them, and they further connect it with the depository. So they hold the shares electronically. Now, this you do, your concept of depository will get perfectly done. So depository is an organization that holds securities in electronic form. It is done through the DP. DP is the intermediary interface interlink. Two depositories, NSDL and CDSL. Depository participants are who are depository participants. There are intermediary interface interlink between the investor and the depository. Done. So they act like an agent for the investor. And how many brokers, these stock brokers can also become DP by getting certified. Now, what is the benefits of depository system? Online shares are there. So physical share certificates, all the loss relating to physical share certificate, bad deliveries, all get eliminated. It's a faster disbursement of corporate benefits. Huge volume can be done. Okay, and these are in fungible form. So what is fungible form? We come to the next thing. Section number 9. Very, very important past exam question as well. So physical share certificates have a identifiable number. They have a distinctive number, ISIN number. So every physical share certificate has a share certificate number. Okay, so I correct myself. They have a share certificate number. But in demat form, there is no specific number or a particular identification. So they are interchangeable. All become interchangeable. Absolutely fine. So all securities which are in demat form are fungible. That means they are easily swapped with each other. A person loses the right to call for the exact security that he had given. Okay, so they become interchangeable. It's like withdrawing the bank. You don't have to worry about the distinctive number at all. Then comes dematerialization. Very, very simple. If you want to keep a dematerialization, the entire process is very simple. What happens is the investor goes to DP, DP goes to depository, goes to the depository. So I will give a DRF form, dematerialization request form. They will further process. Communication will be like this. If the person wants to do rematerialization, for example, I have demat, but I feel that my online account will be hacked, or I'm very old, I don't understand online, then I'll go for rematerialization. I want physical share certificate. That also process is fine. So for that you have to give a RF form, and the process is exactly same. Then comes bank and depository distinction. So bank has cash, depository has shares. Bank allows proper transfer of money transfer. This allows proper transfer of shares. Then we come to a concept called as immobilization. Very, very, very important. Now, immobilization is a service given by the depository. See, normally depository only deals with digital shares, digital online shares. However, they also have a facility that depository can tell that, listen, we have our locker rooms called as safe vaults. We have our lockers called as safe vaults. You can deposit your physical share certificate with us. So let's say I can go, like how you go to the bank and deposit your physical share certificates, to depository also I can do. I can tell the company that, listen, tomorrow if I get, you can even issue me a jumbo share certificate if corporate benefits are given and I get 30 shares. So jumbo share certificates can be given. That is also physical form you can give. So obviously everything is nothing digital is happening. It is all physical share certificates happening. Why I give it? I give physical share certificates to keep in the vault of depository for safe custody. All entries are done in book entry form. Digital entry, nothing is done. Okay, it's just a service given. Okay, you can withdraw your physical share certificates from the vault, from the locker room whenever you want. When fresh issue is made or I get some bonus shares, jumbo share certificates can be issued. Then the same thing is repeated in the form in the act only. So only what is important I will tell you. Now in Depository Act, the 1996 is there. It tells how you can set up a depository, etc. So not important, but still we'll just discuss it, that no depository shall act as a depository unless it obtains a certificate of commencement from SEBI. So they are all SEBI intermediaries. So depository must have got a commencement certificate from SEBI. Now SEBI also, while giving the certificate, they'll say 100 crores you have, 100 crores. So the net worth is important. 100 crores if you have, then only certificate will be granted. You have to give your own bylaws. You should be in the form of a company. That is enough. Okay. So agreement will be made with the DP, depository, and the depository participant. Okay, to facilitate this online share. Now this rule we've already done, that MCA rule 9, 9A, 9B. I'll tell you in short, extremely simple. Directly I will tell you. So what is happening is, and this also has to be read with rule 40 of SEBI LODR, that all issues have to mandatorily be in digital form, demat form. Your listed companies, your public companies, your private companies all have to issue in digital form. Only exception is for small company. Small company can today also hold physical share certificate and issue shares in physical share certificates. Rest everybody, every non-small private company mandatorily has to issue only in demat form and ensure that all their shares are also demat. Done. Fungibility also we have done, section number 9. Okay, what are the powers of SEBI? Headings are enough. SEBI has a power to call for information from the depository participants. They can give some directions in public interest. Okay, and they can make any regulations also. Headings are enough. Penal provisions have been given, not important. What is important is what we are going to come now again further is audits. Okay, now we are going to do audit. Now pay attention, because three types of audits are there that can come in the exam. Okay, SEBI Depositories and Participants Regulations 2018. SEBI new DP regulations. Okay, they call it as a new DP regulation 2018. Now in that they talk about regulation 25. Now pay attention, very important. Three types of audit we will be doing. You need to know that, they can ask you in the exam. Reconciliation audit is given in your regulation number 75 and 76. So what it is important, we'll discuss. Wait, this is a audit under the quarterly basis, this for reconciliation of the issued and listed capital with the depository. Let's see. First then comes internal audit and concurrent audit. And concurrent audit, let's see the types of number of audits that are there. Okay, done. So three important types of audit we are going to do. Okay, now pay attention, this audit you need to know. One is audit, three types. Okay, third one was a concurrent audit. I'll tell you also in short what it is. Concurrent audit is a audit of the DIS. It is of delivery instruction slip. Sir, what it is I'll tell you later, but understand. Second, this is a audit of depository participant. This is the audit of depository participant that needs to be done. And third is a reconciliation audit. Reconciliation, okay, which is given in your regulation number 75 and 76. 75 and 76. Now understand this, before I get into what is what, you need to understand three different kinds of audit, all difference you need to know. More or less it will be same, that audit can be done by CA, CS, CMA, audit can be done by them. Second, the audit will be done on quarterly basis, and the report will be sent to SEBI, Security Exchange Board. These are some of the common points. Now we'll understand each concept very clearly. Reconciliation we had done in our school days also, college, or whenever we do reconciliation, comparing two things. So we'll compare that basically with the DP, depository participant, what records, or with the depository, what records are kept, and with the company's books of accounts, books, is there a similarity or no? So a reconciliation where the depository and books show similar amount of issued capital, etc. This or no. That's all. This audit is done and finished. This audit is about the operations, whether they are operating as per the bylaws or no. And this audit is normally, this is a little older time, that whenever you go and have a demat account, they give you delivery instruction slips. Suppose if I'm not trading on my app, normally like my mom, etc., they don't deal in the app. They have demat shares, but they don't deal directly. They tell the broker. They give the instructions to broker. It's like how you have a checkbook. They have a delivery instruction slip, where that slip they will give it to the broker, that please do it on my behalf. That is it. So we will check whether how many delivery instruction slips was given, whether the instruction slip when it was given, did the broker really execute it, was it done properly. So a check of the slips will be done, like how you have a passbook, checkbook. So we'll see how many were issued, how many were properly maintained, and whether you had implemented the instruction of the client or not. So let's complete and finish it off. Reconciliation. Sir, we are going to reconciliation record. Two records we need to reconcile. So we'll reconcile dematerialized securities with the issuer's data with the depository data. Done. Second, audit. Sir, audit who will do? Audit will be done on quarterly basis by CA, CS, sorry, it is only I done CMA. So it is only CA and CS have been given the powers. So what is it that the chartered accountants and the company secretaries, they will do a reconciliation. So reconciliation of issued capital, this capital held by depository, and that of the stocking, and of that of the issuer. These two will be checked. The audit report will be given to SEBI. Okay, updated status will be given, confirmed and given to SEBI. The audit report is required to give the updated status of the register of members. Obviously, I told you that what is the updated status of the members. Okay, issuer, and confirm that the securities have been dematerialized as per the request within 21 days from the request by the issuer, and where the dematerialization has not been done, the report should disclose the reason for the delay. Means if the company is telling that dematerialize, whether the DP did that in time or no. Simple. Then internal audit of the operation of DP. Did you do the work properly? We just will check whether laws are followed or no. So very simple. The two depositories, okay, NSDL and CDSL, and the participants. So the two depositories, NSDL and CDSL, have allowed CS, okay, to do internal audit. So this is internal audit. Please write this word internal, just in case if they ask, you should know internal audit. internal audit. So depository is telling the DP that do an internal audit. Okay, internal audit of the operations of depository participants. So NSDL has also said and CDSL has also said to company secretaries, chartered accountants and cost and management accountants. So here they all the three professionals are there to do the audit. And what all will we check? All the laws that are applicable to the company, whether the account was opened properly, delay was there, off market transaction, on market, all these words, freezing of accounts or audit will be. Then comes concurrent audit. Concurrent audit, one word you need to know is DIS, delivery instruction slip. Clients, when you open a demat account, you might get a delivery instruction slip. If you don't want to trade it on your mobile, you can even tell the broker, but to tell the broker just call is not a proof of record. You have to give a delivery instruction slip to the broker and on my behalf, please execute this trade. Done. So depository participants have been advised to appoint a firm of CACS holding a proper practice, okay, to do an audit, internal audit, and check the KYC documents furnished by the clients. And the scope of the internal audit will be how many issuance of the delivery instruction slips, how many loose slips were given, how many controls were done, proper register was maintained or no, and verification. Okay, whether it was given by the clients, whether it was executed by the clients, okay, with respect to dormant account, what is the status, etc. So the concurrent audit conduct the audit in respect of all the accounts opened, DIS issued and the controls maintained on the DIS. Any deviations from the law will be reported by the internal auditor and that will further be told to the SEBI. Then with respect to cyber security. Now this is the new provisions that they have introduced, cyber security. Now what is happening is, because it's a digital and all the platforms are giving digital facility for trading, then SEBI cyber security and cyber resilience framework for D. Very simple. SEBI has said that please maintain proper things so that proper cyber security is there. Hacking and all of that should not happen. So comprehensive cyber audit. So 4 types of audit. Fourth one is cyber audit. Depository participants must conduct a cyber audit at least once annually. Compliance declaration that the CEO, proprietors should certify that they have complied with all the SEBI circulars with respect to an advisory issued with respect to cyber security. Critical asset classification. So any kind of assets which they feel is sensitive data, personal information, financial information, they have to classify that this is critical information and they should have to secure it accordingly. Inventory maintenance, they have to maintain day-to-day inventory of the hardware, software, information, assets, networks, data flow, etc. Vulnerability assessment and penetration test. Conduct a proper vulnerability assessment and penetration test means what? A proper normally ethical hacking, they will try that if they can hack the system or no. So they will try, that's conducting a vulnerability and penetration test. We will try dummy entries. We'll check if we can crack through the system. Okay, so there are system auditors who do all this. At least one financial year it should be done to detect whether the system is prone to any attacks and whether it can sustain the attacks or no. Okay, then role of company secretary, very, very important. Company secretary, if you go to see, we are doing audits very clearly. We do reconciliation audit. We can represent the companies before the SEBI and SAT. We do concurrent audit and cyber audit assistance also is given. Clear till here? So 4 types of audit they can ask you in the examination. So there are 4 kinds of audit. Please take a note. From here, 1 can come. 4th is your cyber. That is it. Okay. So with this, we've completed the entire chapter, including all the past exam questions. Hi, so we'll be starting with your lesson number 6, that is your securities market intermediary. Now to attempt this chapter, it's very simple. Okay, you need to know who are SEBI you need to know the intermediaries, then a little bit of their thresholds. Okay, so the meaning has to be clear. It's a very simple chapter if you know how to attempt operate. You need to know the meaning. You need to know what are their key provisions, like what all do these intermediaries do. You need to know their code of conduct, which you can make a common answer for all the SEBI intermediaries, which is very simple. And you need to know their net worth thresholds if given any. Now SEBI regulates the securities market. We all know that. So who is the regulator of securities market? Obviously we know SEBI is the regulator of securities market, but SEBI regulates the security market through its intermediaries. Okay, so every single intermediary has to mandatorily be registered with SEBI. So as per section 11 of the SEBI Act, it is the duty of SEBI to register and regulate the object of the act, right? The main duty of SEBI is to regulate the securities market, develop the securities market, protect the investors, and manage the intermediaries as well. Now, when we see there are multiple intermediaries, what we need to know that intermediaries could be, a primary market in the secondary market intermediaries. So what are primary market intermediaries? When the company is making a issue. So when the company makes the issue to the investor. So this is like a public issue that is happening. So that time we have merchant bankers who manage the entire issue, the registrar and share transfer agents through whom the application forms are made. Okay, the underwriters who guarantee that if the minimum subscription not achieved, they will go and subscribe to the securities. They underwrite the issue. Banking companies who are bankers to the issue, whether application will be received, whether refunds will be made, allotment will be made, and if debentures are being issued, then debenture trustee also. Now very important, these thresholds which are there, I want you to write it down. Okay, because we can write, but the thresholds we normally forget, and that is where you can score. Secondary market intermediaries is when one investor is selling his shares to another investor. So that's called as a secondary market intermediaries, like your brokers, stock broker, custodians, and portfolio managers. Now portfolio managers, they manage portfolios of bigger clients. There are different kinds of portfolio managers. One, they can ask you every time, okay, or they get a discretion to deal on their basis. Imagine if Mukesh Ambani is there, he will tell his portfolio manager, do whatever you want, get me the maximum return. So in order to set up a portfolio manager, to become a portfolio manager, you have a net worth of 5 crores, custodian you require 50 crores. So please note down all these thresholds or take a screenshot. When you see other intermediaries which are their credit rating, so they give ratings to public issue, to the companies. Investment advisors. Now investment advisors are very important. They give investment advice. Okay, investment advisors are non-individuals. They have to be entities which have a net worth of not less than 50 lakh rupees. If they are individuals, investment advisors who are individual will have to have at least a net worth of 5 lakh rupees. So investment advisors who are non-individuals, they need to have a net worth of 50 lakhs. Individuals who want to give investment advice have to have a net worth of at least 5 lakh rupees. Depository participants, they need to have a net worth of 10 crore rupees. So all the thresholds, I hope you write it. The concept we will start. Very simple. So SEBI has passed an act, okay, has introduced the SEBI intermediaries regulations, okay, to regulate all their intermediaries. That is called as a Securities Exchange Board of India Regulations, Intermediary Regulations 2008. Now, this provision is applicable to all the above mentioned intermediaries. Now, since this is applicable to all the intermediaries, it's very easy to elaborate your answer. See, understand? If in the exam, what they will do, maximum they'll ask you one intermediary. So when that intermediary comes, you need to know what they do, what is the threshold, and some common provisions you can mention, that they need to be registered with SEBI. Application they give it to SEBI. SEBI will look at their net worth, eligibility, and then grant them. Okay, the application form, etc. They have to give all the information. So headings you can do, not very important. Before giving an opportunity being heard, it will be rejecting it. Opportunity being heard will be given. SEBI will grant the certificate, etc. Deemed approval. All this is common. Now, according to me, this is a common point which I have made. You can just take a screenshot, note it down. That criteria, what you will say, that if any person is coming to be registered, you will see that he has any past experience, he has a necessary infrastructure, disciplinary action was taken, whether the capital adequacy has been met. This criteria for registration of the intermediary you will see. Now, this is common for all intermediary. So you first in the exam you have to write about the intermediary, then the net worth, and then these common points you can fill to build your answer. Okay, he should be a fit and proper person, that he's going to work, and certificate is going to be issued in the interest of investors. Code of conduct means what? I'm saying this is general, you can write it everywhere, that an intermediary, okay, shall comply with the code of conduct given in schedule number 3. Like he has to operate honestly, fairly, he has to work with proper diligence, he needs to have adequate capacity, he should avoid conflict of interest, he should comply with the laws, he should protect the interest, he should have proper adequate internal controls, he should maintain and preserve the record. So these are some common points and adhere to the best common corporate governance practice. Imagine this much common, if I'm writing, I know I'm scoring really well in this topic, because I just need to know now what the intermediaries do. Then one important point you can write for all intermediaries again, they need to appoint a compliance officer to maintain. Okay, and that compliance officer should be independent and he will report it to SEBI. Okay, now we come to each intermediary individually. First comes, now we are coming to each intermediary individually. Okay, after we do these common points, okay, now we come to each intermediary. Now this is the main thing which they can ask you. First is merchant banker threshold net worth requirements, very very important too. Sir, what are merchant bankers? So merchant bankers are called as manager to the issues. They are called as managers. Okay, so the origin little bit you can write. They are managers to the issue. So in short, if I tell you any issue made to the public, merchant bankers are involved. They will come, they will look at the prospectus, they will do your issue management, they'll ensure that the laws are complied. Okay, so SEBI, so some just to build it, first is merchant banker, means any person engaged in the business of issue management. They not only manage the issue, they also give corporate advisory services. Merchant banking was started by Greenland Bank, it was followed by Citibank and State Bank of India in 1973 and ICICI Bank. So at least I can write that merchant banking was started with Greenland Bank in 1967. The regulation name you need to know, that's SEBI Merchant Banking Regulation 1982. Net worth requirement extremely important, 5 crore rupees. What do they actually do? So merchant bankers, they will manage the issue, they will give you advice, they will help you avail the loan, they will manage your project, they can also act as brokers, they can help you get a loan, they can issue management, they can also act as bankers to the issue. Multiple roles they can do. They can even act as underwriters, trustee, monitoring agency. So all these functions they can. The common general obligations and responsibilities which is there, I have already discussed the code of conduct above. So all this they will have to do half yearly audit. This is same for all, maintain books of accounts. The general obligations are same for all intermediaries. So learn that and you can build your answer, that they will maintain the books of accounts of 5 years, etc. They'll appoint a compliance officer, which I told you these are common points for all intermediaries. Here we just need to know what intermediaries are doing. Second is registrar and share transfer agents. Now registrar and share transfer agents are basically registrar to the issue is in primary issue and share transfer agent in secondary. So they do, whenever registrar to the issue means what? Primary market. So in the primary market, if anyone is coming, you're doing issue, fresh issue is being done, company is raising, they will manage that. Share transfer is between investor to investor, that is in secondary market. Secondary market. Now, the registrar to the issue are related to primary market and share transfer agents are related to secondary market. Now there are two categories of RTAs. One is category 1 who act as both, so they can do both the work, primary market and second. And second is those who act only as solo ones. Okay, they will only do this or that work. Now category 2, they either act as a registrar or they act as a share transfer agent. Very simple. RTA's example you can write Carvey, CAMPS are very famous. Okay? They are very important intermediaries, etc. Functions, what work do they do? So this thing that if it is a registrar and share transfer issue manager, they will take the IPO forms. They will issue. If they are successful, they'll give you the shares. If not, they will give you a refund. Okay, the similar thing to banker to the issue. Very simple. Only banker to the issue is a bank that gives you all these services. They can collect the application. They will take the money received. They will allot it. They'll decide the basis of allotment on basis of the company. Okay, then they will give you refund if you're this, or they will give you allotment later if you're successful. They'll maintain a record in case if you now transmission. Now this is all primary market. Now secondary market is transfer, transmission, nomination will be done. Okay, net worth requirement for category 1 it is 50 lakh rupees, category 2 it is 25 lakh rupees. Done. Next. So the regulation name you need to know. Okay, 1993. So our concept will be very easy. Always any intermediary they'll ask you, you'll write the concept, you'll write the regulation, you'll write the net worth requirements, and then you'll write the common points applicable to all the intermediaries, like general conditions, like your appointment, the registration certificate, audit, compliance officers, code of conduct, honesty, etc. Underwriter. Now underwriter we've been doing. Underwriter, what is the job of an underwriter? Is they would take up the shares as committed by them if the public subscription is not achieved. Regulation is in 1993. All the regulation mostly are of 1993 only. Okay, now we come to banker to the issue. Now banker to the issue is a bank, means a scheduled bank that is giving the same facility: application, allotment, refund, payment of dividend, etc. General obligation is same. Now debenture trustee, we've done in company law who is a debenture trustee. Whenever debentures are issued, debenture trustee will also be issued. Okay, they protect the interest of the debenture holders. Okay, the net worth requirement is 10 crore rupees. Then comes brokers and stock brokers. Okay, now stock brokers are secondary market intermediaries. You can write that they in the secondary market when trading is done. So they help, with respect to buying, selling, and dealing of securities. A sub broker has to be, a person can become a sub broker if he is working for the broker. He shall maintain proper records, preserve the books of account. Same thing, 5 years books of account, appoint compliance officer. So all the common obligation is same for all intermediaries. So prepare a very good one and write it. So the answer is well built. Then comes audit also. So we do the internal audit also. Always remember half yearly audit is done. Okay, and the audit is report is given to the SEBI, and we will do the audit whether the SEBI laws are complied or not. Okay, objective is to ensure that the books of accounts are proper, no law has been violated, etc. Then comes portfolio managers. Sir, what are portfolio managers? So portfolio managers manage the portfolio. Portfolio is a total holding of securities of a person. So high net worth individuals normally hire portfolio managers to manage their total securities. There are two kinds of securities: discretionary and non-discretionary. Discretion means what? An option. You tell the portfolio manager that you can independently manage the account without asking the client, without asking me, you can manage. Non-discretionary means I don't give you that option. The portfolio manager will identify the company, then come for consent to the client, and then only he can do. Regulations are 2020. Net worth requirement is 5 crore rupees. Minimum investment amount. Okay. Now, portfolio managers shall not accept funds less than 50 lakh rupees from their clients. Okay. Then periodic reporting. They need to report on regular basis. Internal audit points are same. Half yearly audit by company secretary, seeing whether the audit is done properly, and then the report will be sent to SEBI within 30 days. General obligations are the same. Then custodian. Now custodian means what? So custodian is a person who has a custody of something. Now imagine mutual funds where physical documents are involved, or gold where they are buying physical documents. So they keep a custody of those things. Safekeeping of gold related instruments, maintaining proper accounts, collecting the benefits received on it, informing the clients about the benefits, and reconciliation of the survey records, whether it is maintained properly or not. Capital adequacy requirement is net worth of 50 crore rupees. Okay, all this is same. Then comes investment advisor. Very, very important. Investment advisor and research analyst is very similar. Now, investment advisor is a person who gives advice with respect to to his clients for money. Now you see, he is engaged any person who for consideration. Free advice is not a investment advisor. Investment advisor is a person who for money is in the business of giving investment advice to his clients. Okay, of what? Investment advice is also only with respect to security. If I tell you buy a house, it is not an investment advisor. If I go and say buy, you should buy something, that is not covered. Here it is only with dealing with securities. Now, investment advice given through newspapers, electronic advertisement, etc., which are widely available to the public, shall not be considered as investment advice. So, something if I just take a general thing and give it on a broadcast it on radio, on YouTube, it is not an investment advice. Investment advice means what? I receive money from you and give the advice to you. So, broadcasting, which I'm as it is giving to everyone. So that is not an investment advice. The criteria, the regulations are 2023. Net worth criteria is how much? 50 lakh rupees for non-individuals, and for individuals it is 5 lakh rupees. Okay, general obligations are same. Research analysts. Now research analysts, their job is to do research and prepare charts, and on that chart they will say this is the at this point you should enter, this point you should exit, this is the lower cap, up cap, this is whether you should buy, sell, hold. That they prepare the research reports and share that research reports to their clients who are paying them. So research analysts do research, prepare a proper charts and etc., and they tell that this is the upper band, lower band, etc. They regulate research analysts, okay, who are engaged in preparing a research report and giving their opinion and recommendation with respect to securities. Research analyst means a person who is primarily responsible is to prepare research reports, provide those reports and tell them whether buy, sell, give price targets, okay, offering any opinion on any public issue that is coming, includes any other engaged in any other research reports or research analysis. Highlight: no person shall, now this is all same, certificate of registration will be given, it will be valid for 5 years, okay, etc. Conflict of interest, etc. Same general things you will ensure. Now coming to credit rating agencies, very, very important, very, very easy also. What are credit rating agencies? So they are in the, like how we see movies, we see ratings. So on basis of the ratings, what happens? I see when I got only 2 stars, I'll not go to see the movie, because a bad rating shows that the company is not really very good. Similarly, credit rating agencies are SEBI intermediaries. They are all related to SEBI, which rates companies on basis of their credit worthiness, how good the company is. So they will tell whether they will give ratings. So every credit rating agency like Moody, CRISIL, Samira, there are different credit rating agencies, Standards and Poor. So they give triple A rated, so I know it's a very good company. Double A, I know it's not good. B or Z. So all these things, they don't tell you whether you should buy or sell. It's not an investment advice. They rate on basis of certain matrix. Decision is left. So for the investor, it helps them in the decision making process. They understand that the movie is not good. Whether I should go or no is my call. So they don't give advice on whether you should invest or not invest. They only rate and leave. So agency that is engaged in rating of securities offered to public. They help you understand how much risk and return is there. Okay, they are CRISIL was set up as the first credit rating agency in India. Then we came ICRA, CARE, Fitch, Brixworth, Samira, etc. Now internal audit, all internal audit of intermediaries half yearly. Okay, report will be made and sent to SEBI, etc. General obligations are same. Then depository participants. This we've already done depository participants in a separate chapter altogether. Then comes a very important authority called as FPI, Foreign Portfolio Investors. Now, foreign portfolio investors means what? Means they are investors who are from foreign entity. They are investing less than 10% in a listed company. Less than 10% in a listed company. That is a definition. It might not be given here, but I'm telling you. Now, foreign portfolio investors, now pay attention to what I'm saying. Foreign portfolio investors and DDP, okay. Now what happens normally when you have a investor will have to go to DP and then only he is allowed to go to depository and then they will invest in companies. So demat process works like this, yes or no? Now here what happens, an investor goes to, now this is a foreign investor. So foreign investor will not go to any random DP. Any random DP they can't go. There is higher criteria of net worth eligibility. So they are called as designated depository participant. Okay. They will tell that if you have this much net worth, you should do obviously since it's a foreign company, this DDP's role is also to do a KYC or detailed KYC of who the foreign investor is there. Then they will go to depository and then company investment. Okay. So who's a portfolio investor? A portfolio investor is a non-resident person who's investing in the securities. Done. Okay, so the rules have been given. Then they have said that the registration rules, that registration eligibility for a FPI. Who can become FPI? They should be obviously Indian cannot become a FPI. They have to be a non-resident of India. They have to be from a country which is following the money laundering laws. They should not be of a country which has been found deficient in complying with money laundering laws. Okay, they are not a Indian only, no NRI. They cannot be in this. They have been granted a certificate by SEBI and they are a fit and proper person. Categories of FPI, we've done that in earlier chapters also. There are two categories. The first categories are mainly government and big organizations who are there, appropriated regulated funds, or they are fund managers appropriately regulated, pension funds, etc. coming here. All others come under, not falling under category 1 will fall under category 2, like individuals, companies, charity, family offices will come under category number 2, who are all foreigners wanting to invest here. Can any random depository participant cater? Answer is no. You have to get a dedicated separate approval for catering to FPIs. So they will then become designated, depository participants where higher thresholds have been given. So they have to be category 1 bank. They have to be registered with SEBI. Okay, and then the certificate will be granted. They have to ensure proper. Now we come to the next criterion. They will ensure proper KYC is done. Now we're looking at SEBI KYC and KRA regulations 2011. Now what happened is, now pay attention to this. When you go to one bank, they ask you for KYC documents. Okay, so what happens? You go to this bank, they'll ask you for KYC documents. You go to your any DP, they will ask for documents. You go to any other bank too, I make an account, I'll have to give KYC documents. I go to any other broker, they will ask for KYC documents. So they said that, listen, why not make a central KRA? All your documents will be kept with KRA. Okay, this is a depository or a repository, or we can say a common database will be maintained. This is an intermediary where anyone opens a KYC document they will have to deposit with the KRA. Once you are registered in any depositories, any participant or any SEBI authority wants, they can directly access this only. So multiple times document need not be given. Let's read and complete it. So to bring in about uniformity in KYC requirements, centralization of the records, you have to upload in the system. So intermediary shall perform an initial KYC. So first time KYC has to be done, and then it will be deposited in this KRA account. So all TARV, etc., they just have to access to the KRA registry, a common database, and they can just withdraw it. Every time we don't have to tell the client to give the data. Then SRO regulations could be, best example of this is NGOs that they are set up. Okay, they are self-regulatory. They only set up, get registered by SEBI. They do some big work like helping the investors. An example of this is AMFI for mutual funds. So they keep giving you the rates, advices, etc. So self-regulatory organization is a NGO that has been set up for a specific purpose. Okay, is an organization that has some degree of regulatory authority. Okay, the objective is to help the investors, ensure that all of them get educated, so manage conflict of interest, etc. Intermediaries, this will be done. Okay, with this, just go through whether we've completed all the intermediaries or no. Merchant bankers, manager to the issue, 5 crore rupees they should have. Okay, then we go to the next intermediary, registrar, share transfer agents of 50 lakhs and 25 lakh rupees. Then similar function is performed by whom? Bankers to the issue. Only thing, they are scheduled banks that give this services. Next, if I see the debenture trustee. Sir, what do debenture trustee do? Debenture trustees are, we run the chapter, they protect the interest of debenture holders. Then we come to the next one, stockbroker. So stockbroker basically ensure that the transactions could be dealt in the secondary market. Dealing of buying, selling and dealing of securities can be done. Then we also saw portfolio manager, discretionary, non-discretionary portfolio managers are given. Then we did the custodian. They have a custody like gold, etc. that is there. Okay, documents, etc. can be kept in custody of the custodian. Investment advisors, for consideration, they have the business of advising. Okay, then comes your research analyst. So they prepare research reports. Okay, and then they publish those reports. Then we saw credit rating agencies. So they rate companies on basis of their credit worthiness, helps investors form their decision making. They do not give decision, they do not tell a buy, sell, hold. They simply just rate the companies. Then we saw depository. Depository, we had a chapter only. Then we have DP also done. Then FPI, very, very important, foreign portfolio investors. Now to cater to foreign portfolio investors, we had, okay, so that is it. We had done more number of intermediaries. Module doesn't cover all those. Internal audit of intermediaries is common for all the intermediaries. The company secretaries will do a half yearly internal audit report, and then within 1 month they give it to the SEBI. Okay, very, very important. All these reports are sent. Yearly audit, this is extremely important. Okay, audit. With this, we have completed the entire chapter. Thank you. Hi, so we'll be starting with a chapter called as International Financial Service Centers Authority. Now, this chapter is about an authority that regulates the IFSC. So, it is nothing but a regulator for this region. So, first we need to understand what do you mean by a International Financial Service Center. Then we will understand that for this center they have made a dedicated authority in India. And then what is the rules, what are the functions of that authority, etc. But to understand that, first we need to understand this particular concept, that what do you mean by the term International Financial Service Center. So first, International Financial Service Center in India is located in GIFT City, Gandhinagar, Gujarat. And this is the only operational GIFT City in IFSC in India. Now this concept has not been made by India. This was already a very famous concept, and countries already have international financial service centers to attract international audience, international companies, and to attract the global investors and global audience. So what is it? Let's understand. So basically this region is first declared as a SEZ, a special economic zone. So what do you mean by a special economic zone? A special economic zone means government has identified an area in which they want to boost economic activity. So how will the economic activity be boosted? Why will someone come in a particular region? So the government gives a lot of tax benefits. So they almost say that this region in India does not have any tax. Plus, just because I don't put tax doesn't mean I will be able to attract companies over the world. They also give extremely good infrastructure facilities. So in Gandhinagar, Gujarat, that is the GIFT City, which is the only operational IFSC in India, they not only have declared the region as a SEZ where no tax will apply, but they have also said that there will be tremendous amount of investments by the government in that region, where they will make it at the international level, where 5G and plus services will be there. There will be a golf course, recreational facilities, etc. So with this, the objective of the country is to attract people in that region. Now the main sector that we are trying to attract is the financial sector. So companies such as banking companies, your insurance companies, your stock exchanges, we want to be attracted out here. Okay, so now we understand what is an International Financial Service Center. It's a center or a financial hub where no tax will be levied, and it is meant to attract companies internationally, globally, and to attract the foreign investment. So if we read what do you mean by the International Financial Service Center, so it is a financial hub, financial center, right? So financial hub within a country, okay, declared as a SEZ, so no tax, so then that's how you will attract, okay, and the main objective is to serve foreign clients. Okay, so after this, what will happen is companies from all over the world will come in India, set up their branches. So Google and many others have already, announced that they will be entering in this particular hub to get the benefit of no tax. So what is an International Financial Service Center? It's a financial center which provides financial services to people outside India. So the main objective is not to attract Indians. The main objective is to attract global companies and tell them to come in India, invest in India, create employment in India. The object, why they will do it? For no tax. Okay. So internationally, it's a very beautiful concept in the IFSCs. Any region whichever is declared as a SEZ or a IFSC, that entire region over the years will be transformed not only by Indian government investing there, but also the foreign companies coming and investing, setting up companies, generating employment, okay, and providing services from to all over the world. Now someone will say, sir, that why we should give zero tax, right? Why we should give zero tax? We are losing on huge amount of revenue. The answer is we have not we have not invented the concept. It's already there. Like Dubai has no tax. In New York, Shanghai, Singapore, they have set up regions called as IFSC. So Dubai International Financial Center is there. So what is happening? In Dubai, you go to see there is like there is an internet city. It is attracting all the companies, even from USA, India. They plan to go and set up there. Why? No tax. So as per the need of the hour, even India realized that we also have to set up a IFSC. No doubt we are not there anywhere close to the top 10 financial centers because we have just started the concept. Okay, so IFSCs which are there, the most famous is the International New York for International Financial Center. Then you have London, Singapore, okay, Dubai. These are all the countries which have set up IFSCs where no tax will be there, and the top government is saying that they will invest up till X amount there. They will transform the entire region, give the best facilities there. Okay, so this is how we have the Dubai International Financial Center, and now countries are starting to face a pressure that listen, this entire region in X country has declared it to be no tax, so everyone is going there. So now we want to bring them back and compete with countries like Dubai which are saying zero tax. Okay, so in India we've made the GIFT City. What is the full form of the GIFT City? Is your Gujarat International Finance Tech City. Okay. And this entire concept was in India was formulated by your Percy Mistry. He was the former chairman, okay, of HPEC and also the director of World Bank. So he brought in the GIFT City in India. The entire conceptualization was done by him. Now we can understand that this region is there. It's going to have no tax, lot of benefits, lot of investments from the government, and that's how we will be able to attract foreign companies and get foreign investment, generate employment, boost exports from there. So that's the way that how Dubai has given zero tax, we also give zero tax in that particular region. Now since that region is there, okay, we have made a dedicated regulator for that particular region called as International Financial Service Centers Authority. So SEBI laws, SEBI is does not, and none of the regulators apply. There's only one regulator there, International Financial Service Centers, which does functions of all the four. So RBI, if someone wants to exchange foreign currency, okay, from let's say rupees to dollars to pound, okay, to euros, it is freely exchangeable. There is no exchange rate applied because RBI laws only don't apply there. So there are around RBI Act, SEBI Act, Insurance Act, Pension Act do not apply to IFSCs at all. These regulators don't apply. Instead, they have one unified regulator, International Financial Service Center Authority. What is it? If one line I have to tell it, it is a unified regulator in IFSC. So no laws apply there. There are stock exchanges, but they don't require SEBI approval. There are foreign exchange that is happening, but they don't, RBI doesn't have control there. There is a lot of pension services also, okay, pension for employees, etc., and they have a fund there. But your pension fund regulatory development authority, they also don't have powers there. It is only one regulator called as IFSCA. Okay, so what is the benefit of this? As you can understand that the role of IFSC is to access foreign capital. So all the foreign companies will come here, do a FDI, foreign direct investment in India. So we attract foreign companies and it becomes and on the other hand, it will be a gateway to channelize the flow of foreign capital into the Indian capital market. Common sense that we are trying to get all the funds into India, and since we'll also make, there are 3 stock exchanges today in your IFSC, so funds are also coming into the capital market there. Okay, now if in short, if you have to understand what is an international financial service center, I just told you it's a center for and a financial hub which caters to foreign companies, foreign clients. So in financial service centers are those who cater to customers outside their own jurisdiction. Now, what is the importance of the use? Obviously there will be boost and economic activity will be grown. Okay, socio-economic activity will be there. We will be able to accelerate globalization, means we will also be able to reach out to the world and create a gateway or a path where foreign companies and Indian companies, because Indian companies are also getting listed in IFSC, relocating in IFSC so that they can cater to outside India. Okay, growth will be there in that region. Now, my simple question is, why would foreign companies come here? Is the simple reason and the most important also, no tax. What is there? No tax. So you will see no capital gains tax, no STT, no long-term capital gains, short-term capital gains, no commodity tax, nothing. For the purpose of tax, it is treated as a foreign territory. So now we will understand that what are the benefits for foreign companies to be relocated here, to be being setting up their companies out here. So first you will see that there is a 100% tax exemption for 10 years out of 15 years. So the company can decide that in 15 years time they will get a 100% tax benefit for out of 15, any 10 years they will select that these 10 years I am choosing for which I will pay no tax. Okay, so then after that a little bit, these are called as sunset clauses. After that the benefits will start to go down, go down. Then you will see that so that flexibility is there, that out of 15 years you can choose your 10 years in which you don't want to pay any tax. Then comes MAT and AMT is your minimum alternate tax, and alternate minimum tax will be at 9%, where in normal companies it is your 18% for other companies. So no doubt tax exemption is there, but it's not 100%. There is a lot of benefits given. Then even the interest income paid to non-residents. Now if you go to see in this region there will be a stock exchange. Okay, and on stock exchange you will have companies listed. So let's say foreign companies will be listed. Okay, when they are listed, obviously a foreign company can issue shares, they can issue debentures, etc. So now let's say when debentures are issued, bonds are issued, so then they will pay money to the foreign investors. Let's say a foreign investor, Mr. A, who is living in USA, as an investor, invest in a company listed in IFSC. Now what is happening? They are saying that normally when he would have invested, Mr. John would have invested in USA, the interest rate that he would get in his USA would be 1 and 2%. Here these companies will give 4% FD rate or the interest on debentures. So it is way above the global average. So here you will say that they will get good amount of interest when they invest in these particular things, and the gains that they get is not chargeable to tax. So investors, first of all, they'll get good returns, and on those returns also it is tax free. Second, we'll see dividend paid to the shareholders also is exempt. Okay, then companies do not have to pay any dividend tax on it also. Okay, then you can write that GST, no GST. Now imagine GST is such a big tax in India. If someone is setting up a company, 18%, some have 28% GST. Imagine on whatever goods you're dealing, GST is exempt from tax. Then if you go to see your subsidies, state subsidies, lease extent, as government is saying that we want to boost economic activity, government will give a lot of financial benefits called as subsidies. Then you will see these are zero, nil rate tax, okay? Security transaction tax, commodity tax, DTT, DDT, your long term, short term, all of this is exempt. So then they say necessity for bringing this IFSCs, why did the government want, again we've already discussed, is to onshore the offshore international financial services. So to onshore means to bring back what had gone abroad, which has gone to Dubai, which has gone to Shanghai, which has gone to Singapore international financial centers. Now because they are giving less tax or no tax and a lot of benefits, so worldwide companies are getting located. So here we want to onshore, we want to bring all those financial services which are going away to different countries to bring back into India, okay, and to change, to improve the trajectory of India to a 5 trillion economy, and to showcase Indian talent that even India can compete at a global stage. IFSC benefits for India, obviously there is tremendous benefits, that there will be internationalization of rupees. That means people will say India and India's currency is rupees, and in that we can even issue bonds which are denominated in rupees, like how today when bonds are there it is in dollars. So we can also sell bonds which are in rupees called as masala bonds. So rupee becomes famous and stronger, okay. Now what is this authority? Now this authority has been created under an act. The name of the act is IFSCA Act 2019, okay. Out of this act, it has, now we will just see the repetitive thing, that the object of this authority is to develop and regulate the financial market in IFSC. Very simple. What is the object of this authority? To develop and regulate the financial market in this region, and to combine all the 4 major regulators. All these 4 major regulators will be unified into one authority. It empowers the IFSCA to exercise the powers of 4 domestic regulators under 15 central acts. So there were 15 acts like RBI Act, SEBI Act, SEBI has multiple acts, Insurance Act, there were around 15 central acts. All of them have been clubbed to give all the powers to IFSCA, okay. And one word I want you to remember is develop and regulate, DR. You will write this word SIP. So the main objective, this is written in the object of the act, so you have to write it, that the objective of IFSCA is to develop and regulate. S is for financial services, I is for financial institutions like your banks, etc., and P is for to launch financial products. So this is the objective, okay. So again, what is it? Financial services, financial institutions, and financial products. Now we will see 2 important sections. Now till now I have not told you anything that learn this section, but now I will tell you. First is your functions of the IFSCA is given under section 12, okay, and this is the functions, and powers are given under section 13. So no matter what exam question comes, you will always have an opportunity to write what is the object of the act and what is the powers and functions of IFSCA. It is same we have discussed, nothing new. To develop and regulate SIP, done. And 13, if you go to see, is your powers of the authority. So again, where the powers come from, 15 central acts have been clubbed and the powers have been given. So here all the powers given in first schedule. Now when you go to the first schedule, this is the first schedule. So we are seeing the powers Under which section? Section 13. Okay. Powers. So very simple. All the powers of the four regulators. RBI powers they will get. RBI acts are there. So these are the powers. SEBI acts are there. IRDA acts are there. Okay, and pension acts are there. That's it. Okay. Now SIP we know. So we will write at IFSCA. This line I want you to write and quote it in your exam, that IFSCA is a unified authority, okay, to develop and regulate financial SIPs. Done. Okay. What are financial products? What are financial services? Very simple. Financial products are given under section 3 subsection 1D. So securities. So financial products, basically to sell financial products with what? Shares, debentures, insurance, etc. Okay. Currency. Now innovative, they have also said some new financial services like your aircraft lease, your bullion spot delivery, and bullion depository receipt. So let me tell you. So new kinds of services they will products they will launch. Like any company, you see, they keep launching new products to attract money, right? So here we can say they are thinking of tapping a new market called as aircraft lease. So any company wants to buy an aircraft, we will lease it out. So companies can be there that we will become financiers. NBFC, have you heard? Non-banking financial companies. So they can finance purchasing of aircrafts. Banks can finance purchasing of airlines. Shipping also they have come. So anyone wants to. So if you go to see, they have tried to target airways, where anyone wants to buy a aircraft, they can take a loan. This company will be set up, financial company will be set up to allow that you can go and take a lease, or aircraft you can take it on loan, ships you can take on loan. Then there is the bullion. Bullion means gold and silver. What does bullion mean? Gold and silver. So gold and silver spot delivery contracts are there. Spot means what? On the spot delivery and payment. So if I want to buy gold, I will pay the money and take the gold. That's a spot. Depository is written is where you are trading in gold and silver online, digitally. So depository deals with electronic. So today I do buy gold bees. So I don't buy physical gold. I buy it on app. I don't know whether you know, trading app, you can go and buy. So you can go ahead and do this. This is a fresh product launched there. Operating lease. So financial lease is where you are allowed to buy the entire asset. Operating lease is for a shorter duration. Lease can be taken. Ship lease, as I told you that shipping companies can get listed there and they can provide leasing services. Then financial services. Now when I see services means what? Professional services, insurance services. Okay, so these are all goods and services that they have given you. Okay, now very simple, just if you can remember some new financial services given here. Global in-house centers. What is in-house means what? So big companies, financial companies can set up a GIC, Global In-House Center. So global in-house centers are a particular subsidiary of a multinational company, okay, that will handle the operational part or any particular operations of the company. Simple. So they provide some kind of ancillary service, a kind of a any service, not the main product, not the main thing. So it is just an in-house backend office that a MNC can set up. Now we come to the listing and trading of securities. Very simple. You can list your shares. So companies prefer to list on stock exchange. There are total of 3 stock exchanges made. Normally we have NSE. So NSE will make a subsidiary stock exchange, and that stock exchange will be set up in your particular IFSC. So it is allowed that any stock exchange can be set up in your IFSC, but it has to be a subsidiary of our current existing recognized stock exchange, and companies can get listed there. And there is a concept called as even a special type of company is allowed, which is called as special purpose acquisition company, which can also get listed. I'll tell you what is the concept. It's important. It'll come in sometime. Then they have said that even ESG products will be launched. What are ESG? So any kind of activity which is socially and environmentally beneficial, they are called as ESG projects. So they will, IFSC's role will try to take initiative, boost the ESG initiatives, zero carbon, okay, sustainable goals, etc. Green bonds is basically we will use the money for environmental purposes. Social bonds is to develop a particular region, society, people, uplift people, etc. Now, very simple, when we see to the listing aspect, so the listing says how the listing will be done. So listing could be, just imagine a company could be listed first time, so it is called as IPO. If they make a public issue, it is called as a FPO. You can even list up as a startup, okay. You can list up your depository receipts, which is to trade online. You can list your debt securities, debentures. You can list ESG related securities, some securities which will raise money and use that money only for ESG initiative, environment, social or governance related aspects, okay, ESG. Now let's come to the part where IPOs can be made. Okay, so we saw IPO can be made, FPO can be made. So they've given you thresholds. What is the eligibility? That numbers you'll have to just go through. Who is eligible? So not every company can get listed there. So they have given you that they need to have an average pre-tax profit of $1 million. Okay, and operating revenue of $20 million. Issue size should be minimum of $15 million. So these are some thresholds that you need to know. Minimum subscription has to be of 75% of the issue size. So whatever they are planning to raise, 75% of that should be subscribed, and anyone promoters holdings will be locked in for a period of 180 days. Then we see startups. Even startups can get listed. Now when we see a startup means what? A startup means a company which is not just, it means it must be new, means it must be less than 10 years of incorporation, it must be small, it is a turnover has not exceeded this much. But the most important thing of a startup is that it must be working towards innovation and it is scalable business model with high potential of employment generation. That can be called as a startup. So they have given the thresholds for that as well. Okay, then we come to a concept called as special purpose acquisition company. Market is important. What is it? It is basically a company made and it will get listed. It's a company, it's a listed company whose will not have any operating business. So it is a listed company who does not have no operating business. So imagine a company which has been made. It is not going to sell goods, it is not going to sell services. The main objective of a special purpose acquisition company, from the name itself, is to acquire another company. So the main job of this company is to acquire another company. So they will say that, listen, I'm getting a company listed, I will list it up, and the main job is to buy out some other company. Okay, that is it. So they will not do any business. There will be a time frame in advance. They will not tell who they are going to buy. They will just say we'll get listed and our main objective will be to buy out another company. Okay. So the listing of this, also they say that the main objective of a special purpose is to do a merger, amalgamation, acquisition. This is the main objective. There is no other objective that they will have. Okay. So now obviously to get listed they will have to raise money. So offer size will be given, minimum application, subscription, etc. So what is the objective if they acquire? So when they acquire another company, that business will get listed. So imagine if a private company is there. So this listed company, because it takes a lot of time to apply for listing, approvals, etc. So they do all the hard work. I raise money, I tell all of you, let's get a company listed. We'll get it listed, and then a fast-paced startup company will be there. We'll tell them, listen, we'll do a merger. Once we do a merger, you will automatically become a listed company and you will be able to operate. So you will save time from doing all the procedure to get listed. So they'll say, makes sense for us, we will pay you X amount, you all leave. So we will say, okay, see, we have invested so much, all our investors have paid so much and we're looking for so much return. They will happily pay us, we'll happily leave, and the business will be them, and we'll give them this is the fastest way a private company can get listed, by merging with a listed company. So this is the entire objective. Even debentures can be listed. Okay, even debentures can be listed, and these debentures, if it is denominated in rupees, then it is called as masala bond. So what are masala bonds? Masala bonds are a bond on which interest, principal, etc. will be paid just like any other bond. But the unique thing is, it will be mentioned, all the details will be given in rupee terms. No dollar, no other thing. So this amounts to internationalization of rupee. So rupee seems to be a good currency in which people will be buying, selling and discussing. Okay. Now, one important thing that they have said, which I want you to say, that post listing, after you get listed, okay, post listing, you have to appoint a compliance officer. Okay, any kind of changes in your KMPs you have to disclose. You have to disclose your shareholding pattern. Obviously you will disclose financial statements. You will have to set up a whistleblower mechanism in audit committee. If you know, a whistleblower mechanism is that if there's any wrong, it would be mentioned that who to complain. Okay, that's called as whistleblowing. You will have to give sustainability report. What are you doing for the environment? Okay, that all will be given. Very important point is a listed company. Now imagine the scope of company secretaries has been enhanced tremendously in the IFSCA, where it is said that a listed company must appoint a company secretary as a compliance officer. So this I feel, and the job of us is to ensure that the IFSCA is compliant. So it's a tremendous opportunities, since the act and regulation itself is recognizing company secretaries as compliance officers and stating that every listed company mandatorily has to appoint a company secretary. Okay, and that is it. We've completed the entire chapter. Thank you.